This is a joint oversight hearing of the Senate Judiciary Committee and Banking, Finance, and Insurance Committee, being chaired by myself and my wonderful co-chair, Ron Calderon, Senator Ron Calderon. We're here to discuss the implementation of important foreclosure laws that have been passed over the last few years here in Sacramento. The legislation we're talking about today sought to address the serious issues facing Californians who are in foreclosure, at the risk of foreclosure, or who may be affected by a foreclosure. As we all know, California and our nation is in the midst of one of the worst economic crises since the Great Depression. California as a state currently leads the nation with one of the highest rates of foreclosure. Over the past 3 years, the legislature has worked diligently with industry and consumer groups to respond to the various foreclosure issues facing homeowners, tenants, and our neighborhoods. The enacted bill sought to address these issues, confronting Californians in several ways. By requiring homeowners to be contacted before facing foreclosures and potentially losing their homes, encouraging the implementation of comprehensive loan modification programs to keep people in their homes, enhancing the protections for tenants living in foreclosed properties, banning advance fees for loan modifications, and empowering local governments to act to ensure that foreclosed properties are being maintained properly in our neighborhoods. Today, we have an excellent opportunity to provide oversight on this legislation through this hearing and hear directly from those who have implemented the legislation, those that have been affected by it, and we will be hearing real-world testimony, which will be key for evaluating whether the bills have been implemented in a manner consistent with their intent and whether there is need for cleanup legislation. And most importantly, today's hearing will provide a public forum for discussion about each of these important foreclosure bills. We will have a total of 4 segments in today's hearing, and Senator Calderon and I will be taking turns in providing the leadership in the hearing. The first segment, we will hear an update on the most recent foreclosure numbers. Our second segment will provide an opportunity to discuss the foreclosure avoidance, tenant notice, and anti-blight provisions of SB 1137, SB X 227, and AB X 27. The last 2 segments will focus on SB 94, the recent ban on advance fees for loan modifications, and SB 1055, which dealt with the issue of foreclosure tax relief. After all the panels have concluded, we will have an opportunity for public comment. And I just want to thank my co-chair, Senator Ron Calderon, for his great leadership on these issues, and it's been a pleasure working with him over the past few years. And now, to you.
Pass the baton. Well, welcome, everyone, to our oversight hearing. I think it's nice to be able to get back to the normal way and normal routine of doing things rather than, putting out a budget fire, which we do over and over again every year. We're able to actually do what our designated job is, and that's to oversee legislation that has been passed or proposed and how effective it might be working. I want to join the chairwoman, Ms. Corbett, in extending our welcome and thanks to all of the witnesses that have joined us today. The issues we're discussing are extremely important to Californians, and I appreciate how many of you were able to come here and testify today. We've got a lot to cover. I'm going to be as brief as possible on my open remarks, but I do have a few comments that I would like to offer. First, there's a great deal of frustration surrounding foreclosures in California today. I share that frustration. Over 1.2 million notices of default have been recorded in California since this crisis began. Over 500,000 homes have been foreclosed upon. Last year alone, California experienced an average of 554 foreclosures per day. An average of 5 per day as far as those numbers are staggering, in my opinion. Now, there's no question that a lot of people bought homes that they couldn't afford. And a lot of our foreclosures are also economically driven. In a state with the 12.5% unemployment rate, not everyone is going to be able to afford to keep their home. But a bad economy and a high unemployment rate don't explain everything. For example, why are borrowers disconnected or put on hold for long periods of time when they call to ask their servicers for help? Why is borrowers' financial paperwork lost repeatedly with their servicers? Why are borrowers denied a loan modification without being told why? Why aren't more short sales being offered to borrowers who can't qualify for a loan modification? And why are some servicers foreclosing on borrowers with whom they're still actively negotiating an alternative to foreclosure? Today, I have the same message for all of our witnesses. The legislature wants to reduce the number of foreclosures and restore the health of California's housing market. You, our witnesses, need to help us figure out the best way to do that. Think outside the box. If you don't like the solutions that we've enacted, offer new ones. If you don't like the idea of more legislation, give us an alternative. But focus on helping people. Be a good neighbor, because the status quo is not acceptable. And I look forward to hearing from all of you today. Now, before I call up the first witness, do any of the other members of our committee want to make any opening remarks? Senator Price?
My leadership in calling this hearing today. I know in my district, foreclosures is the, I don't know, it's 1 and 2 with jobs, certainly a concern that we all have. This foreclosure crisis has, I think, affected everyone, touched everyone one way or the other, if not directly, indirectly through a family or friend. And so we have made some efforts to correct the situation, or at least temper the situation. I think, Chairman Calderon, you hit it right on the head when you mentioned that it really we want to work together. It has to be a collaborative effort, seeing what works, what doesn't work, what can be improved, or what can be implemented in a way that we haven't done before. So I'm anxious to hear the testimony and to work with my colleagues as we try to find some answers. Thank you.
Thank you, Senator. Okay, let's begin by asking Mr. Mark Skilling, Chief Operating Officer and General Counsel on Foreclosure Radar.
As just stated, I'm Mark Skilling. I'm Chief Operating Officer and General Counsel for Foreclosure Radar. Thank you for inviting me here today to speak to you. Foreclosure Radar truly appreciates that. Foreclosure Radar is a software company. We specialize in the collection and dissemination of foreclosure information. One of the things that sets us apart from other similar companies is that we track the auctions on a daily basis. We let our customer know what's going on at the auction continuously with respect to sales, postponements, and cancellations. We serve all of California as well as 4 other western states. Our customers are primarily, actually the majority of which are the auction investors down on the courthouse steps. They're the realtors. We are a strategic partner with the California Association of Realtors Business Products Division. In addition, we have government clients who use us for community outreach purposes, for mosquito abatement, for code enforcement, and for law enforcement matters. Now, Foreclosure Radar was asked to come here today to speak to the numbers on the topic. 3 years, over 1 million notices of default, and counting. Where are we now? And I thought we might start that by showing a year-over-year analysis of the foreclosure filings and outcomes. Now, I ask that these charts be given out to each member because I know that you won't be able to see my charts. Very good. Okay. Now, first I want to draw your attention to the green column, and that represents the notice of default filings. As you'll see, there's been a trend upwards from 2007 to 2008, and then again from 2008 to 2009. There was a 58% increase in NOD filings from 2007 to 2008. And then there was a further increase, but a smaller increase of 14% from 2008 to 2009. A similar trend can be seen with the notices of trustee sale filings, which is the blue column. There you can see that there was an increase of 125% from 2007 to 2008, and then from 2008 to 2009, there was another increase, but a lesser increase of 10%. At the conclusion of 2009, there were over 500,000 notice of default filings and 390 notice of trustee sales. Now, those were the foreclosure foreclosure filings. With respect to the outcomes, we have the red column, and that represents the what was sold at auction, either going back to the bank or sold to a third-party investor. And you'll see here that there was an increase of 154% from 2007 to 2008, but then it dropped from 2008 to 2009 by 20%. Less was being sold at auction. Also, I wanted to point out cancellations. Cancellations have increased year over year with an increase of 112% from 2007 to 2008, and an increase of another 57% into 2009. So what we really see here is the foreclosure filings have been increasing year over year, but the outcomes have been decreasing. So we're having more foreclosures, but less people are being foreclosed upon. Now, I wanted to show you the same foreclosure filings and outcomes on a lineal basis, month to month. And what you'll notice here is in September 2008, there was a significant drop in the green line, which represents the notice of default filings. That was the same month that SB 1137 became operative. The other thing I want to point out on this is the blue line, which represents the notice of trustee sale filings. You'll see another drop, not quite as dramatic, but you'll see a similar drop in June of 2009 when the 7s became operative. Now, next I wanted to drill down a little bit on this to really give some emphasis on what's going on here. So I looked at it on a day-to-day basis. And on a day-to-day basis in September 2008, when SB 1137 became operative, we see that on the Friday before, on the 5th, there were 2,979 notices of default filed. The next Monday, on the 8th, September 8th, 174. So there's quite a drop, and that drop remained constant through the month of September.
Before you take that down, so you attribute the drastic drop in the, I guess, the the time it took to comply with 1137 and adjust to the requirements, and then once the lenders were all in compliance, then the foreclosures, according to the previous chart, started going back up again?
Let me show you the next chart. I think it'll be demonstrative of that question. So we pulled back and looked at the same metric, but on a month-to-month basis, and I think this will probably answer your question, Senator, where we see the drop. Well, in the month before, in August, the total filings for that month were 43,531 with respect to notice of default filings. In September, the month of SB 1137, it dropped to 16,757. But then, I think, as you were alluding to, 3 months later in December, it's climbed back up to 44,000 2019. So adjustments were made.
The adjustments were made.
Now, we looked at the same sort of analysis with respect to trustee sale filings and the sevens. So on the Friday before the operative date, on June 12th, 2009, there was a rush to the recorder's office, and 4,129 notice of trustee sales were filed. Then, on the 4 days later, it dropped to just 268 in June 16th, 2009. We pulled back to look at this on a monthly basis as well. And we see in May of 2009, 43,407 notice of trustee sales were filed. Then in June, the sevens operative month, 30,751. Then the next month in July, it was back up to 40,805. This is all of California.
Yes.
So does that mean then, if I understand your graph, that in the fifth month there were 43,000, and then you add 30,751 to that number, making it total?
No, this is in the month of May, the fifth month being May. There were 43,407 notices of trustee sale filed in that month. The next month, there were 30,000 new ones filed.
So does that make the total trustee sales filing 73,000?
Combined for those 2 months, yes.
Then you add the third month together, you add another 40.
Yes.
40,000.
Yes.
Okay. Thank you, Mr. Chairman.
Sure. Now, I know that there's been other initiatives and activities other than SB 1137 and the sevens, so I wanted to bring some of these other events into focus along that earlier graph I showed you with respect to outcomes and foreclosure filings on a month-by-month basis. Here again, we see the drop, which occurred in September of 2008, the same time as SB 1137. But also we need to remember that that same month was when Fannie Mae and Freddie Mac went into conservatorship with the attendant moratoriums, and also that's when TARP was rolled out. And then later on, in February 2009, there was voluntary lender service moratoriums with the onset of the probable onset of HAMP, and then in fact HAMP did get rolled out the next month in March 2009. Then we have our sevens occurring in June 2009, and now we're waiting to see what happens with HAFA. Now, all of these initiatives and events have had an impact. That's clear. What's interesting is we looked at the days to foreclose, and this would be the day from when the notice of default is filed until the trustee's sale. And back in the first quarter of 2007, that was 132 days. Now, it's 226 days. That's 94 days longer to get through the foreclosure process. Of those 94 days, 27 of those are in the notice of default stage, and 67 of those days are in the notice of trustee stage. Now, I had one last chart I wanted to share with you.
So basically, it's taking longer and longer.
It's taking longer and longer.
Eventually
Exactly.
lose their home.
Well, the one other point on this, which is sort of interesting, is if we look at it in perspective to September of 2008, that's when we really start seeing the climb in the number of additional days it's taken to go through the foreclosure process. This graph looks at the mortgage delinquencies, notices of default, and trustee sales together. And it looks at them as a percentage of all the homes with a mortgage on them. So we'll see, and I know you can't very see on this graph very well. You probably can on the ones in front of you, but there was the trend downward of the notice of default filings in 2009 from 2.3% to 1.5%, and that's what we'd expect to see. We also see that the sales were relatively flat at 0.08% over the last 3 quarters of last year in 2009. But if we look at the delinquencies, those have climbed considerably from back in the first quarter of 2007 at 1.3% to 11.3% as of the last quarter of last year, 2009. So what that's telling us is there's more and more people who aren't paying their mortgage.
Yet staying in their homes longer.
They are staying in their homes longer, absolutely.
Yes.
And that's all the charts I had to share with you today. There's for the audience, there's additional charts in the back, and then also I've shared with you the California Foreclosure Report that we publish each month, which will give you some additional data points for you.
Thank you.
Senator Cogdill had a question, and then Co-Chairman.
Thank you. Just a quick question on the definition of delinquent. When does one become delinquent? Is this if your payment's due on the 1st and you haven't paid it by the 15th and you are subject to a penalty on your payment as a result of that? Are you considered delinquent
After 30 days.
at that point?
30 days past due.
Okay.
After 30 days.
Thank you, Mr. Chair. I had a couple of questions, and I'm not quite sure if you'll be able to answer this, but this is sort of looking into the future. Do you have any data or at least an opportunity to sort of guesstimate the number of homeowners who may be at risk for foreclosure in the upcoming year? Any trends that can help you guide us on that?
Well, here we're seeing that there's 11% that are delinquent. I guess
Right.
I would define all of those as at risk.
Potentials. Mm-hmm.
That's of about 6.5 million homes in California that have mortgage. So 11% of that figure, I guess I would consider at risk.
Okay. And then my other question is, can you also give us any thoughts on whether current foreclosures are mostly due to jumps in current mortgage payments, continuing resets, or maybe what percentage may be due to resets in mortgage payments, and those that may be due to more traditional type reasons, loss of employment, which is leading to the inability to make payment. Do you have any thoughts on that?
I really don't. I know, and I think we all know that initially the resets of the exotic loan products caused the problem. Now there's a significant problem due to the negative equity.
Right.
And so now people can't move. They can't refinance. Mm-hmm. And then so when life's events bring them to the point where they have to do one of those events, they can't sell, they can't escape, they get foreclosed upon. They walk away from their house, which is no longer an investment to them. It's just a lost money cause.
Okay, thank you very much.
Thank you, sir.
Okay, thank you.
Okay, great presentation. Now I'm going to ask the regulators to come forward. Preston Duffichard, our Commissioner of the Department of Corporations, Jeff Davey, our Commissioner with the Department of Real Estate, and Ken Sayer-Peterson, Acting General Counsel for the Department of Financial Institutions. Gentlemen, thank you for joining us today. Mr. Duffichard, I believe you're going to start us out.
Thank you. Senator Calderon, Madam Chair, and members of the committee, my name is Preston Duffichard. I'm the California Corporations Commissioner. To my right is Ken Patterson from the Department of Financial Institutions, and Commissioner Jeff Davey from California Department of Real Estate.
Pull it up closer. There you go.
Can you hear me now?
Yes.
Thank you. So I've been asked to talk a little bit about our experience with implementing the various foreclosure prevention acts in our departments. And I wanted to say, first of all, I want to thank you for holding this hearing. I think it's a very important hearing to hold in light of the fact that we have now implemented a number of foreclosure prevention acts. And while our experience is relatively narrow given the time period through which the California Foreclosure Prevention Act has been in effect, I think we have seen some promise from what we have done so far. So I'd like to talk about what our experience is through two different lenses. One is through the lens of our examinations, and the other is through the lens of complaints that the department has received. And to give you some background, the department has a examination protocol, which is to say whenever there are changes that affect our licensees, we have examiners go out and examine the books and records of the companies we're responsible for regulating. So after the governor signed the Foreclosure Prevention Act in February and it became effective in June of 2009, we began to have an examination protocol whereby we would look to our licensees' books and records to make sure that they were complying with the appropriate provisions, not only of the Foreclosure Prevention Act, but also SB 1137. So we would actually look to see that there was adequate documentation. The lender's declaration was there. That
each and every
case, as well as the toll-free numbers that they had were supposed to provide in connection with SB 1137 and some of that stuff. And where we found deficiencies, we made we had the lenders address the deficiencies, whether in fact documentation existed but it wasn't in the file, or whether the consumer didn't receive the appropriate. A lot of times it was just the 800 number or some missing reference. So that experience has been, like I say, narrow. We've noted some violation, relatively modest number of violations. That experience, however, is limited to our licensee population.
Were the violations inadvertent? Were they, in most cases, and quickly corrected?
Quickly corrected and inadvertent. And some of them were also just they didn't have the documents in the files. There was substantiation that they had contacted, they had done something, but it just wasn't in the file. So they actually had the documentation someplace else. And so those have been the types of violations, but that experience is relatively limited, which is to say it is only limited to the companies that we have visitorial authority over. We can't, through federal preemption, as you are well aware, we can't go out to national banks and examine their books and records to make sure that they're in compliance.
Have you, to date, penalized anybody for not being in compliance?
We haven't penalized anyone. We have denied exemption requests for about a dozen companies or so.
What does that represent in the entire world?
I think for all, we have about 59 approvals. Collectively, all three departments have issued about 110 approvals for exemption from the Foreclosure Prevention Act. So that's our examination experience, and I think the more telling experience that we have is through the complaints, and I will refer to them as complaints because that's how we document them. But in fact, they're for the most part requests for assistance in dealing with lenders that we get. So we've noticed a dramatic increase in the number of requests for assistance or complaints, and that experience is more universal in the sense that we get requests or complaints about national banks as well as our licensees. And since I'm in communication with a number of national banks, if we've given them an exemption, for example, under the Foreclosure Prevention Act, we will then direct the complaint to the bank, to the appropriate lender, for them to address in dealing with the consumer. And we've seen an increase in the number of complaints, as I say. In part, I think that's due to the fact that we're now on people's radar screens a lot more as a result of our having, implemented this law. So the process through which we deal with the complaints is, as I say, we write a letter to the appropriate lender and ask them to get in contact with the borrower and we follow up. They copy us all of their communications with the borrower, and we follow up. And the kind of complaints we've seen is some of the things that you've heard about anecdotally, I'm sure. Borrowers not receiving paperwork, or lenders losing the paperwork, et cetera, et cetera. Lenders will initiate the request for financial information. They may or may not get the entire list of financial information requested from the borrower. Those are the most common types of complaints.
This is actually fairly common in the mortgage industry in general.
Right.
I was in the mortgage area too, and getting information back and forth usually takes a long time, and there's usually a lot of follow-up involved. So this doesn't sound like it's out of the ordinary.
It's not. I mean, and I think, as I say, we're seeing it at an increased scale because we're on people's radar screen a lot more today than we were 2 years ago when this situation first got started. For loan modifications that are denied for whatever reason, we see the reasons for denials as well. The borrowers lack the income to accommodate a loan modification. I think one of the things that we've noticed over the years since this foreclosure situation first got started is there's a changing pattern. I think when the foreclosure crisis first got started, it was really attributable predominantly through lax underwriting standards, some of the exotic products. Now it's more through unemployment and those types of situations. So those are the primary types of complaints and lack of denials. We've provided some statistical information as well concerning what we're doing in the Foreclosure Prevention Act category. We're able to collect certain categories of data, not, as I said earlier, from federally chartered institutions, but again from our licensees. And I think some of the most important data points in the charts that we provided are the fact that we are seeing a reduction in the monthly payment for loan modifications. That was a criticism that a number of consumer advocates had brought up some time ago, that people were getting modifications, but they weren't really good modifications in the sense that the monthly payments would actually increase. So we wanted to make sure we charted that data point to assure that for people who are coming through and getting exemptions under the Foreclosure Prevention Act, that the monthly payment for consumers was actually going down. There were a number of federal initiatives taking place at the same time, so I don't know that all of this can be viewed in isolation. But as I say, there are positive signs that we've seen. I mean, I got the data from the foreclosure radar today, but I had seen other data points suggesting that the foreclosure numbers had actually gone down in California.
Commissioner, you brought up a pretty interesting distinction between the exotic loan programs and then most situations that are occurring now having to do with unemployment in the economy or some major change of life, a death or divorce in the family or something like that. Do you have any data as to when the offering of these types of no income qualifiers, negative amortization loans, high adjustable rate loans, how long it's been since lenders in general have stopped offering those, so that we can maybe get an idea as to at what point in time and forward are we looking at mostly economic things that are causing the problem?
I don't have a precise point in time where when I can pinpoint they stopped offering those products. I know no lender offers the payment option ARMs today that I'm
Is it illegal to offer those?
It's not illegal.
And it's not illegal to offer a no income qualifier?
No, those are not illegal. It's just that as a result of the credit crisis, lending requirements have really...
Understandable.
We passed certain regulations dealing with non-traditional
They have to be
mortgages.
underwritten now more.
They have to be underwritten
stringently.
more. They have to make sure that the borrower has an ability to repay the loan.
Right.
It can't just be underwritten for the basis of the collateral. You have to look at the primary source of repayment as the borrower's income, according to our regulations that all of the departments passed a number of years ago.
He's getting all the questions, guys, so.
That's great. Perfect.
Feel free to amplify.
I was just going to say ditto.
Yes, we have a question. Senator Cogdill.
Thank you. You mentioned that the majority of these workouts are resulting in lower payments. How is that structured? Is that as a result of a lowering of the principal amount? Is it an interest rate reduction? Is it an extension of term? Is it some kind of balloon payment that's negotiated at a later date?
Yeah.
What's the majority?
As I understand, the primary driver behind modifications is interest rate reductions, particularly for subprime borrowers. I mean, many times you think subprime loans, well, they started at the initial rate, which is the teaser rate. Well, the teaser rate was really 9%. So, and we're in a very low interest rate environment currently. So it's easier for banks, and you'll hear from the banks a little bit later on. But that's where I think they have the most flexibility is in lowering the interest rate on the loan. And that can drive down the monthly repayment. But the waterfall is doesn't limit them to that. Clearly, they can tack on some portion of the principal to the end of the loan. But the primary driver in most of these modifications seems to be interest rate reductions.
Okay.
Great. Thank you.
Okay.
Does that conclude your presentation?
Yeah, I mean, unless there are any other
have a
questions, I'd be
question.
happy to answer.
Oh, I'm sorry, Senator Cox and then
Let me,
Chairwoman.
and maybe just ask the three of you, and by the way, thank you very much for coming today, but I'm sure you saw the foreclosure radar presentation talking about the days to foreclosure. Started off on the first quarter of 2007 at 132, is now up to 226 days. And so I guess the question that I have, and I want to follow it up with another question after I've asked this one. In your opinion, what is the primary factor that has taken this from 132 days to 226 days?
Well, if I can just, I'm Jeff Datter from the Department of Real Estate. I mean, it's clearly attributable to the two bills that we're talking about that passed. The SB 1137 contributed around 27 days to that number, going longer. And then when you take the Comprehensive Foreclosure Prevention Act, that contributed on the back end after the notice of default was filed, as the gentleman from the radar mentioned, another 60 some odd days. So that's where that discrepancy comes from. You combine those 2 days together and you come up with a 90-day increase in the time it's taken to get to the property.
So with the addition of the days, has that changed anything in the marketplace relative to the actual foreclosure?
Yeah, yeah.
Okay.
I'm sorry. As the last chart that he showed indicates that the actual number of foreclosures has reduced. And I think you raise a very interesting point, Senator Cox. With the increased number of days, the emphasis on communication between the borrower and the lender, that has actually gotten people to look at modifications in a sort of a wider time context, and has actually brought down the number of actual foreclosures.
So is it the lender then who has had a change of attitude?
No,
My presumption is everyone who's in a home is trying to figure out a way to stay in that home. And so to the extent that you continue to extend the days, if you go from 132 to 226 and you haven't solved any of the problem, you've got a different issue on day 227.
I think there is another statistic that we heard about very early on, Senator Cox, that I'd like to bring into play here to address that question. The very early statistic that we heard going into all of this, before 1137 was passed and all this, is that more than half of the people who receive a notice of default lose their home without ever making any contact with their lender. So what these bills have done, it's not just the lenders having a change of heart. It really has been driven by a better level of communication by the borrower and by the lender in coming together to try to talk about what deal can be done to structure a modification to keep people in their homes. So that's been sort of the outcome that I think we can point to as a positive outcome as a result, not only of the lengthening of the time, but in the reducing the actual number of people that get pulled through all the way to the foreclosure process.
It is also a situation that, good, bad, or indifferently, it also keeps the case open, if you will, and keeps the home from being on the marketplace for an even greater period of time. So as a result, it is a situation that the aspect of getting the house back on the market must have some merit.
Yeah, well, the aspect of getting the house back on the market would make sense in a robust marketplace, but we haven't really been operating in a robust marketplace. I mean, in other words, the downward pressure on home prices has been such that it's not really, getting something on the market quickly doesn't serve anyone's best interest. So the fact that you actually are lengthening the time through which you pull through a foreclosure means that that house is not on the market. The market prices don't suffer quite as drastically in particular areas because that house isn't on the market.
Thank you, Mr. Chairman.
Thank you. Senator Corbett.
Thank you very much. So I would then follow on with the question. It appears that the loan modification programs appear to be working.
I would say yes. I mean, there are criticisms leveled against all of them, but for the most part, I think what we have to do is much like the bailouts. Mm-hmm. Everyone criticizes the bailouts for picking winners and losers, et cetera. But I think compared with where we would be without these programs, mm-hmm. I would say absolutely they've been working.
That's great. That's really great news. Have you had any occasion where you've had to deny exemptions because of failure to continue offering loan exemption or loan modification programs?
We've denied exemptions for companies that have applied for them, basically because they didn't provide an adequate description of what their loan modification would be, and they're not a HAMP participant, so we've denied loan modification.
But there's been good compliance with those that have entered into those programs.
Yes.
And you've been following, you have a follow-up on that where exemptions have been granted due to the loan modification programs. You've been following up on that.
Yes, for our licensees, we have the ability to do that, yes.
Okay, very good. So that's working too.
Yes.
More good news. And then my last question for that, on the where you have had to deny applications, have you had the opportunity to continue to work with those entities to put together a successful program?
We have denied some initially, and they've come back, and we've worked with them. Mm-hmm. Pardon me, Senator. Some of the ones that we've denied early on were very perfunctory applications, but they knew they were, for example, going to sign up for the HAMP program with the federal government, and they came back with a subsequent application that identified that they were now in contract to comply with HAMP, and so we granted the exemptions on that basis.
Mm-hmm. Very good. So the overall picture is that even though some people may be concerned that we're slowing down the process a bit, more people are having maybe an opportunity to save their homes and stay in their homes.
That's what my impression is, yes.
Okay,
Senator.
very good. Thank you very much.
All right.
Thank you.
Thank you.
We're going to move on to Mr. Davey, and then we're going to end with the best for last.
Okay.
And just before you begin your testimony, I just kind of want to make an overall observation based on the charts, based on what we've heard today from you gentlemen. Even though the time that people are staying in their homes is increasing, in many of those cases they're continuing to pay something on their mortgage. Mm-hmm. And the notice or the foreclosures have started to come down, at some point, we're going to reach that level where it's purely economic, and that's why they can no longer stay in their home, and we'll weed all those out at some point. So I guess what I'm saying is giving somebody a little bit longer to solve their problem has helped a lot more people stay in their homes, but we will eventually get to the point where it's an economic issue, and then we need to start talking about other solutions, which we're going to hear from a little bit later on today. And with that, Mr. Davies, I'd like to
Okay. Thank you, Senator Calderon, Senator Corbett, and members of this committee, the Joint Committee. Thank you for having me today. I'm Jeff Davey, the Commissioner for the Department of Real Estate, and I did provide a small packet to you, which I hope you all have, that includes two sides to it. The left side is the copy of my testimony from today, which is very brief because of the involvement the Department of Real Estate in terms of its licensees has in the California Foreclosure Prevention Act. Commissioner Dufresne did a fine job of summarizing, and the handful, if you will, of my applicants are also in his data. However, just to let you know what we did do at the department, we have a total of 150,000 potential brokers that are licensed by the department that could have fallen into this category. Obviously, a very small number of them did. We drilled that number down to 600, and then from there, we got down to around 26 overall applications that came in for the exemption. Of those 26 applications, only 14 were granted, and of the 14, only 5 were of the level of magnitude in terms of loan servicing that applied to owner-occupied units and this bill that would warrant the reporting back to the department. So we've also followed up with those 5 brokers as well, and their servicing. We've had no complaints from them, although we have received numerous informal complaints from individuals talking about the same things you heard Commissioner Dufresne talk about, and some of you mentioned, taking too long to get our loan modification response back, losing paperwork, not dealing with the same people at the lender. But again, we don't regulate the lenders, and we don't get official complaints about those lenders. The 5 that we do monitor, we didn't have that situation occurring. I'm going to just go ahead and leave it with that because really Commissioner Dufresne summed it up very well, and you have our information. I am going to be coming back later to talk about SB 94 in the agenda.
Great.
Thank you.
Yes, sir, it's your turn.
Chairman Calderon, Chairwoman Corbett, members of the committee. My name is Ken Sayer-Peterson. I'm the Acting General Counsel for the Department of Financial Institutions, and I have to start off by apologizing on behalf of Bill Haraff. He was on vacation, and when he got back to San Francisco, some emergencies arose, as you might expect during this economic time, that kept him from appearing, and he does apologize for not being able to make it. I don't have a lot to add. The commissioner to my left has done a wonderful job. I would say that we have been dealing with a heavily regulated series of entities, the credit unions, the banks that are in this state. Of the 35 exemptions that we have actually allowed so far, 26 of them are from institutions, credit unions that we actually charter, and we have the examination authority over. 6 are federally chartered credit unions, and 3 are savings banks or banks that are under the purview of the federal government. What is nice about that aspect of it is that we do have the ability, as does Commissioner Dufresne, to go in and examine, though our examinations may be a little bit more involved than the commissioners, because we're also looking for safety and soundness. But at the same time, we are examining for compliance with the Foreclosure Prevention Act. And
let me ask you a question while you're on that, Mr. Peterson. Based on the data on the charts having to do with the notices of defaults versus the foreclosures and the numbers over the years, how do those numbers, do they reflect the exempted, those loans that may have fallen into the exempted lenders and institutions? that you have on?
Yeah, I would say so. It's what's interesting to me about this.
So if they were not exempted, maybe the numbers might be a little bit better, or do you think they just pretty much be this?
I do think better, to be honest with you. The one thing that our licensees who do and most of these, interestingly enough, are credit unions, do first and second mortgages. They make the mortgage and they hold them. There are not a lot of our institutions that are basically the ones who create the loan and sell it to the marketplace.
Right.
And as a result, I think they're a lot more careful, if I can speak on their behalf, in their the loans they have granted. Also, as I was basically in charge of the processing of the exemption requests, I found that they added more than the law allowed or required in their modification programs. Some actually reducing principal, not just pushing a balloon payment to the end of the loan, as you were wondering. They actually did reduce the payments. They reduced the principal as well.
So it's their success ratios as well that's contributing to the drop in the foreclosures that we were just shown.
I'll say yes.
Yeah. Okay. Okay. Well, I think that's pretty important to take note. Are there any changes? We're going to go to the next part of our hearing very shortly, but I just want to have an overall question. Are there any changes that you, the three of you, would recommend to existing legislation that might make it better or worse for homeowners?
I don't have any specific changes that I would recommend. Clearly, if there's a good idea, we'd be happy to consider it, but I don't have any specific changes that I would recommend.
Are there any other questions that members? Yes, Senator Cox. Okay.
Gentlemen, you talked to your counterparts in the other states. California better off, worse off than foreclosures and others? I'm trying to understand the dynamics of our policies, and so not everyone has done what California has done, so I'm trying to understand the dynamics. So when you talk to the Department of Corporation or the Department of Real Estate, are their numbers close to California's numbers? Are they different? Are they better? Are they worse?
Well, first of all, let me say there's no other state like California in the sense that we have.
But that's a given. So just set that, and the next thing you're going to say, there's no other legislature like the California. Right. So set that part aside and just see if you can figure out whether or not there's anybody that has got numbers that we can compare to.
Well, I mean, that was my point. I mean, I think we have roughly 6.5 million mortgages in the state, and the second closest state, I think, is going to be less than half of that. I think it's Florida. So,
but I'm talking about Nevada, Arizona, New Mexico, Oregon.
If you look at those states, I mean, and I get briefings by the Mortgage Bankers Association economists and about what's happening in the western states or the sand states or whatever they want to call them. If you look at the data. California is going to be high just in real numbers just because of where we are and the number of mortgages we have. The rate of foreclosures, Nevada is the highest by a pretty good sizable number, but they have fewer mortgages, but they are number one in terms of the rate of foreclosures, and their economy has suffered as well. Where California has been very successful is in coming down, at least at the last MBA conversation I had with their economists, we've actually come down in the actual foreclosure starts. And that's attributable directly to some of the foreclosure relief efforts that have.
Speaker of the Assembly or the pro tem of the Senate of Nevada, I believe, is a lady who came to California to testify before an Assembly committee about telling us how well they were doing there in comparison to California. Is that not accurate?
I don't know. I wasn't at that hearing.
We'll just have to, we'll wait then. Thank you for your...
So we're hearing different things with regard to what the future will bring, and I'd just like to hear your thoughts on this. Do you believe we are coming out of this serious concern about foreclosures due to, the exotic products? Are we moving out of that stage? Are we still going to see a wave of resets that will cause problems? Are we now transitioning into this new period of foreclosures due to more traditional issues, as Senator Calderon stated, with regard to people, loss of jobs and those sorts of things? Are we moving out of that period? Can we see the light at the end of the tunnel with regard to resets, I guess is what
well, I would answer that question by saying I believe so, with one exception, and that's the pay option arms. Mm-hmm. And because that's an area where we are sort of just seeing those loans being recast. Now, those loans were typically Alt-A type of loans, mm-hmm. and so there may be a confluence of factors at play here to the extent we are seeing more prime borrowers defaulting. That may be one and the same, and it's difficult to separate out type of product versus economic factors regarding those loans.
Okay. Gentlemen, any other comments on that?
I was just going to say, I think one of the biggest fears that I have is the interest rate. Mm-hmm. If the interest rates start to climb, and there's to the extent that you do have adjustable mortgages out there, it's going to be more and more difficult for people to make their payments.
Yeah, and on the interest rates, I just one point on that. The Fed met today, and one of the things that they concluded, and this will have direct bearing on where interest rates are going for the ability for people to refinance. They will stop buying mortgages at the end of this month, and so that announcement has been made. So I think interest rates on mortgages are probably going to experience an increase of a certain number of basis points.
Okay, thank you very much.
Thanks.
Oh, Senator Leno. And
thank you. And thanks to the chairs for convening this hearing. I think for the entire panel, all of us, of course, in our legislative offices are hearing the most horrific stories from constituents who are calling us on a regular basis. I'm sure that comes as no surprise to you. We're hearing from constituents telling us about the lost paperwork, going round and round in circles, getting different answers from different people in different offices. They're trying to ward off a foreclosure, and they just can't get anywhere at all. If a consumer came to you, any one of your offices, and shared a story that in the attempt to apply for and receive a loan modification, without any forewarning, their house has been sold. Does that bring any of you into the situation? Is any regulation law been broken? It would seem the consumer has not been dealt with fairly.
Yeah, that
Have you ever heard of this happening?
The way the current legislation is structured, that shouldn't happen. SB 1137 makes clear that there needs to be efforts made to communicate with the consumer by the lender, and if they've breached that law, then there would be some room for redress by the consumer. But if they came to our office, we would immediately contact the lender and say, "What? This can't be right." I mean, you.
And is this not happening, or is this happening?
I have not heard of that situation, Senator, specifically.
We haven't received any complaints along those lines either, directly.
None whatsoever.
No, I do get a lot of the similar kind of complaints because I deal with mostly the individual real estate brokers and people trying to get their loans modified. And although I have heard those kinds of complaints, when you look further into it and you find out that, in fact, they were contacted, the proper procedures were carried out, their perception of what took place was different. So I've not come across anything where it ended up being a violation.
Okay.
But I have gotten a lot of those kinds of calls and complaints.
Sure.
Recently, we were, for one particular reason, going through several cases that have been filed in Sacramento County Superior Court, and we found 8 alleging the very thing that you're saying. So there are those people who are doing it, but the real redress is in court. There isn't much we can do to help.
And I would just echo what Commissioner Davey said, Senator. I mean, I have been made aware of, I have been told by consumers that they've been unable to communicate with their lender. And when you scratch behind the surface, that's not really the story. But I've not been made aware of any situation where, in fact, there's been no communication and the house was sold under them.
So you were asking for some suggestions earlier. I'm just thinking, might it make sense that before any foreclosure can be proceeding, that someone who's in the process of loan modification either get a determination one way or the other, and in the case of denial, with explanation before foreclosure can proceed? So it's not just communication, but before the foreclosure, if you're in the process of loan modification, you would either get a determination that yes, you qualify, or no, you don't for these reasons. And until one of the other happens, we wouldn't let the foreclosure proceed.
I'm not. I hadn't heard about that type of a suggestion. I mean, and when you say foreclosure, foreclosure has many different meanings. There's the notice of default, which kind of begins the process, and the notice of trustee sale.
We're talking at the end of the process.
So there, I don't have an opinion about that. Whether that would be more successful or yield a higher degree of modifications, I can't address it at this point. Yeah.
Anyone else?
I think it would need to be vetted. I mean, there could be some merit to it. We need to see exactly. You want to be very careful if you look at that type of thing, because we talked about the number of days involved with this whole process, and what we've done in the past, what you've done as a legislature, has contributed to those days. And I want to be very careful as to how we continue to affect that, because we do want to get California recovered and through all this. So I just think we need to be very careful that we process and move forward and not overreach things. And so it's always worth looking at, but I can't say that's the answer right now if you don't.
Where do you see the overreach in this particular situation?
Just we could over-legislate ourselves to the point where we impact California's recovery, which we know is forthcoming, and we can't, of course, predict in terms of the overall economic situation. Real estate, of course, is reaching some sort of a bottom. Prices have reached an all-time low, and there will be some recovery in the future, whether it's 2 years, 3 years. And so we just wouldn't want to, I think it'd be very prudent to be careful how we proceed as a state and as we continue to pass legislation. That's all I'm saying.
Because I'm just thinking that if we want to encourage loan modification, again, without changing the rules,
yes,
you either do qualify or you don't.
Right.
And if we want to prevent future unnecessary foreclosures, because someone may actually qualify for loan modification, which could keep them in their home, and then have all the ramifications that won't bring down prices further in that community. It has all sorts of benefits to it, the fewer foreclosures that we have, as well as the benefit to that particular homeowner, that if someone is in the process of loan modification, that before the foreclosure process really unfolds, they just get a determination. You do, you don't.
My comment was just I think it would have to be fairly vetted, because that's effectively a moratorium of foreclosures until that process completes, right? And that has impacts. That has impacts on what the lender's able to do in terms of filing required notices. It will impact the time period. That's all I'm saying. I'm not saying it's not a good idea. I'm not saying it's a great idea. I'm saying it needs to be looked at and it should be considered. But I can't say, there it is. That should be done right now.
Deserves further debate. No.
All right. Thank you very much.
Thank you.
Fair enough.
We do need to move along. We're way behind. Senator Hancock had a question. We're going to finish with Senator Cogdill, and then we're going to start with Senator Corbett's part of this hearing.
Two quick questions. Do any of your offices have a clearly identified ombudsman that people who are negotiating mortgage modifications could contact in the case like something that Senator Leno cited? And secondly, if any of you have any comments on the interplay of state and federal law as it affects the work that you do.
in terms of a contact, I think we all have people that you can contact. I would, if that scenario you described where that took place, I would say contact our mortgage lending unit at the Department of Real Estate. There's an individual there that runs that part.
Do you have a loan modification division
unit.
department?
It's the mortgage lending brokerage unit.
Well, I'll tell you that this Federal Department of Education, which has been in student loan scandalville in the last months, has also lots and lots of people. One of the issues is they have an Office of the Ombudsman, but no one ever finds out about it. So what I'm hearing is there is no Office of an Ombudsman, but if you call the people who aren't calling you back again, maybe someone will help you. I would say that's not a very clear way to help.
So who do I call if I'm
forward.
experiencing problems with my loan?
Our MLB unit, and it would be the Sylvia Regulin or Tom Poole, who's in my office, and I can
Could
give
you
you that.
provide that with
yes,
us
of
so
course.
we can pass along our
Yes, of course, and we would respond. We don't fail to respond.
And I can tell you what I've described our process a little bit earlier, where we respond to the complaints and by directing the lenders contact the borrowers directly. Where we don't get involved is in negotiating on behalf of, of the borrowers, the particular aspects of the modification.
Okay, because you see what I would need, what other legislators, what loan modifiers might need, the nonprofits that are doing this, is to say there's an Office of an Ombudsman. Nobody's returning your call. They've lost your paperwork. Your bin time is expanding. Call this number, and somebody will try to move it for you.
And we have been successful only because, since we're the regulator, we're able to get things moved a little bit quicker than I think consumers would be on their own. I agree that there's been a certain amount of frustration in the process in terms of just the consumers dealing with the lenders, and we've been able to help just by speeding the process.
We have one more question. Senator Cogdill.
Thank you. Just to follow up on comments that Senator Leno had concerning that situation where somebody is in the process of getting a loan modification, but the lender ultimately forecloses on their home in the middle of that process before the determination is made. Do you have any examples of that? I'm trying to understand why that would be in the benefit or to the benefit of a lender to go ahead with a foreclosure that obviously is going to cost them an awful lot of money to get a piece of property back that's not worth the mortgage on it if they can work out any kind of a modification to keep the loan in place and payments coming. So I'm just wondering, are there situations like that going on right now where lenders are jumping the gun when they've still got somebody in process for a possible modification?
Could be a federal lender.
Sure.
It could be federal.
Sure.
Yeah, because that is always a difficult thing for us to deal with, being state regulators. And we do have that interplay between state and federal law and those that are federally licensed. But
Gentlemen,
I've never seen it, to be honest with you. Not in our
Doesn't seem to make any sense to me.
No.
It doesn't.
It would seem to cloud the title, so I don't know why that would happen. And on the interplay between the federal and the state laws, with the consolidation of the industry participants, there's been, I guess I could say, while I communicate with the federally chartered institutions, I can say my regulatory authority, I recognize the limitations of my regulatory authority, and if I didn't, they would remind me.
We all need to recognize our limitations. Thank you. I'd like to thank the panel for being here today. Very informative. Thanks for all the questions. At this point, we're going to move on to the foreclosure avoidance, tenant notice, and anti-blight efforts, part of our presentation and hearing today. And with that, Senator and Chairwoman Corbett, please.
Thank you very much, Chair Calderon. And it's also my job to help try to get us back on the time frame. We thank the three gentlemen that were. No, it was an excellent discussion, and I think we learned quite a bit from it. And it wasn't your fault. We were just learning some very, very important things. So we're just going to try to get back on schedule. And I'm calling upon the consumer advocates to please come forward for a total of 30 minutes on this particular portion. So I would ask Paul Leonard, who's the director of the California Office for the Center for Responsible Lending, to come forward. Lisa Sitkin, who's staff attorney for Housing and Economic Rights Advocates, and Norma Garcia, the senior attorney for Consumers Union. And welcome to all of you. Thank you for being with us today. Mr. Leonard, you can go ahead and start if you like.
Thank you very much. I've got a presentation, copies of which will be circulated to you.
Thank you.
Shortly. I have taken the liberty of avoiding a full-blown testimony and gone to a PowerPoint presentation, which I think hopefully will be more efficient for you and more efficient for me as well. I wanted to make sort of three main points today. Clearly, the California foreclosure crisis continues, and as a simple matter, and as was just literally reported today by CNBC, despite all of everyone's best efforts, policymakers, servicers, advocates, delinquencies are continuing to outpace modifications with the risk that we will continue to have an ongoing foreclosure problem with us for many years to come. Despite our best efforts, both federal and state efforts to promote sustainable and affordable loan modifications have been disappointing. It has been just a far more difficult, knottier problem, and the nature of the problems that have been attempted to be addressed have essentially been changing over time. So no fault to anyone here, but in terms of actually coming up with really effective solutions, I think we're still looking. And then finally, we would argue that additional efforts are necessary. Every additional foreclosure is not only hurting the borrower and having them lose a home, but is also resulting in substantial declines in neighbors' property values and a decline in revenues, as well as the disruption of having people move, having children go to new schools. The foreclosure radar folks presented the trends in foreclosures and defaults. I have a chart here that shows kind of the same trends over time. I think one point to make about this is that as that you've seen sustained higher levels of delinquencies than you have seen in increased foreclosures, which means what some people are talking about as a shadow inventory, an inventory of houses that are still in process somewhere, that have not yet been foreclosed upon, that raises real questions as to whether or not they're going to end in modification, whether they're going to end in foreclosure, or whether they're just going to stay in this kind of limbo land for some foreseeable period of time. The current conditions that we have today, I think, are still remarkably bleak. One of the points I wanted to make that in the foreclosure radar report that was in the back of the room and that was released yesterday showed delinquencies up month to month after a 3 or 4 month decline here in California. New notices of delinquency were up 20% in February. So this idea that we're sort of easing out of this crisis, I think it's way too early to declare success. The numbers, I think, are still quite staggering. MBA fourth quarter data, 1 in 6 of all California mortgage holders is now past due. 1 in 8 borrowers is now seriously delinquent, meaning either 90 days past due or in foreclosure. And perhaps most importantly, and not yet focused on enough, I think, is the fact that more than 1 out of 3 mortgage holders in California is underwater. Meaning the value of the mortgage is greater than the value of their home. And perhaps most importantly on this is that it's not by just a little bit. 60%, according to First American CoreLogic, 60% of all underwater borrowers have loan-to-value ratios of greater than 125%. So they're underwater by more than 25%, which means that even if we get some stability in the marketplace and we return to normal appreciation rates, borrowers and owners won't be seeing equity gains in their homes for many years to come, that this is not a short-term proposition. The next chart that I have shows what we think will be which has been touched upon, but will be a significant problem, which is the wave of new loan resets, particularly around Alt-A and option ARMs. The total figures in this brightly colored chart, this is a chart that's put together by Credit Suisse, shows about $253 billion in option ARMs that are going to be resetting and $164 billion in Alt-A loans. that are going to be resetting between 2010 and 2012. I should point out that this is a greatest challenge for option arms, where borrowers have, by and large, been making minimum payments, and at a certain trigger point, the options all go away. And those borrowers are forced to either pay a much larger, fully amortizing payment or face some other modification arrangement. Payment shocks associated with those resets are in the order of 50 to 120%, depending on interest rates. I should also say that we know that about 60% of all the option arm inventory, this is national data, 60% of all the option arm inventory was originated here in California as so-called affordability products to allow people to try and get into the fast appreciating bubble market during the boom years. These are national data. But 60% of all the option arms, I'm not sure what the percentage is on Alt-A's, although we can get that for you, are in California. The other thing that I think is critically important to point out is that clearly now state policy is interacting with federal policy. And on the loan modification and foreclosure avoidance arena, the big dog in the fight here is now the federal HAMP program. It was a program that was announced last February, really took effect in around May of last year. And so after 9 months, and being a standardized federal program providing financial incentives to servicers, as well as to the owners of the note, as well as to borrowers, the performance on that has been very disappointing, to say the least. I've included some data here that show that a few permanent modifications, the very, very tiny proportion of permanent modifications that have been established through this program across a number of different servicers, the 4 major banks as well as a few other large servicers. And again, what you see is that through February, I believe, these numbers show less than 10% of all eligibles are receiving a permanent modification. That's not to say that this reflects all of the efforts of the servicers. If you turn the page and say, we know that as of a report released a few days ago, there have been 1.1 million trial modifications offered to borrowers so far, but of that 1.1 million, only 170,000 have converted to permanent modifications. Similarly, in California, about 170,000 trial modifications and only 35,000 permanent modifications. And again, just as a point of contrast as to how well we're doing with these modifications, to go back and think about it, 35,000 permanent modifications since the start of the program last year. During the same period of time, we had just under 200,000 completed foreclosures here in California and roughly 500,000 notices of default. So I think we have a long, long way to go in terms of thinking about how to be effective. Some would argue that part of the problem here is that the modifications that we're not converting them. So far, we know only 1 out of 3 trial modifications has converted to a permanent modification. I think that originally when the HAMP program was started, many servicers were not doing upfront screening, were not doing upfront income verification, were not necessarily applying even the rules of the HAMP program to get people into the program. And for those borrowers who are going into this program with the hopes of getting a permanent modification, not only will if they end up in a foreclosure, will their hopes be dashed, but they will also likely have been paying additional payments over this period of time when they've been in the modification. As if they hadn't been in the program in the first place, presumably they would have moved more quickly to foreclosure. And the other part that I'll talk about briefly here and then a little bit more later is clearly the negative borrower experiences. And I think we have all heard and read countless stories about the problems that borrowers have had in trying to negotiate with their loan servicers, in getting just a basic level of efficient service, in being able to get their questions answered, in being able to get timely responses to their loan modifications. And I know my colleagues will talk about that a little bit more. With respect to the specific bills that the state has passed, we supported.
Mr. Leonard, just for a time check, you're at about 11 or 12 minutes right now, and
Norma
So I
said
don't
she
know if
was
each have
giving me
10 minutes
3.
each, or, okay. Well,
Norma-
just so you know, it's just a time check.
Absolutely. Absolutely. The bills that have been passed before in general, a couple of points to make in general. One is they were attempting to address specific challenges that were identified at the time. CRL ended up supporting these initiatives and certainly thought they were worthy when they were put forward. But the important point is that the perceived obstacles to modification in many cases have changed over time. Specifically with respect to SB 1137, the primary concern at that point of time was making sure that servicers would actually get in contact with borrowers. So we established a specific communication protocol to make sure that that would happen. We had hoped that that communication would lead to meetings between servicers and borrowers and more modifications. The way the process worked, it did not have a substantial expansion of the formal foreclosure process. All of the 1137 provisions were required to happen before the notice of default was filed, so had no impact on stretching out the formal foreclosure process. The results of this, I think it's very, very hard to evaluate the impact of 1137. We understand that by and large borrowers are getting pro forma declarations from the servicers or the trustees as they move to foreclosure saying that they have complied with the provisions of 1137 without documenting what, if any, contact was made, what, if any, meetings had occurred, what, if any, modifications, conversations actually happened as a result of that bill. On the 7s, the goal was slightly different. We were at a time in which a big issue at the time was on redefaults, and as a result of not having modifications that were actually substantially lowering borrowers' payments and not having a systematic programs in place for servicers to make sure every borrower got considered. Ultimately, the 7s, we believe, when we supported it, built momentum and supported implementation of the federal programs. I think in general, what's made clear, and as Commissioner Dufouchard pointed out, most of the servicers quickly enrolled in the HAMP program and automatically received an exemption from the 90-day extension of the process. Continuing obstacles to more modifications. One is the issue of servicer capacity, and I will leave that to my colleagues to elaborate on that. Second is, if we want to have, the second category, I think, are the big 3. The big next 3 are lack of principal reduction, which threatens the question of whether or not the modifications that we're having are going to be sustainable over time. The continuing challenge of negotiating around second lien holders, who are often refusing to get out of the way and preventing more modifications from happening, and as we have all acknowledged, the growing unemployment challenge. The policy implications of this, I think, are important. We believe that the state should adopt a proposal that would require eligibility for HAMP or a servicer's other loan modification program to be determined with a denial, if necessary, before the start of the formal foreclosure process, that is, before the notice of default. This would be building on the nature of SB 1137, which was a process that occurred before the notice of default was filed, but would actually address what we would fulfill the potential of 1137 to make sure borrowers aren't slipping through the cracks and making sure that they're going to avoid foreclosure, especially due to servicer errors. The second piece is that we are very fortunate here in California to be just about to get $700 million from the TARP funding for the California Housing Finance Agency to design some programs to address the big 3 issues: principal reduction, unemployment, and second liens. So that's a very exciting prospect. And we believe that we need some federal changes to make the HAMP program work more effectively. And either at the state or the federal level, I think it's critically important to get more detailed loan-level data on loan modifications than we have gotten to date. The HAMP program is collecting that data, has not yet put it out. The rest of the data that's been available has all been aggregated up to the point where it's very hard to determine what's working and why, and whether there are specific servicers who are doing better than others. One of the things we've seen from the HAMP data is clearly some servicers seem to have found successful ways of providing modifications more so than others, and I'll turn it over to my colleagues.
Senator Cogdill has a quick question.
Thank you very much. In your presentation, when you talk about the 2.4 million California owners underwater, 35% of all the mortgages, and 60% of these are with loan-to-value ratio greater than 125%. Do you have a dollar number, estimate, total amount of
I will get that.
Represent?
I can get you that figure. I don't have it off the top of my head. We did an estimate recently that's looked at borrowers who were in foreclosure in California, and we found that on average they were $144,000 underwater.
And just another similar questions, as far as ways to handle this bailout, if you will, that took place at the banks because of the mortgage issue, have you seen any analysis where someone said, what if we gave a bank holiday to everybody that's paying on a mortgage that we know is upside down for a year, and the federal government cover that in either a tax break or in some way to make up that difference, what the impact would have been if we'd have done that rather than the bailout that took place at the banks and then left all these mortgages in place at the other end?
I have not seen analysis of that sort, sir.
Okay, thank you.
All right, next speaker we have till about 1:15.
Am I on? Okay.
Yes.
I am a staff attorney, Lisa Sitkin, at Housing and Economic Rights Advocates in Oakland. We are a nonprofit legal services agency. We provide advice and counseling over the phone to borrowers throughout the state and more in-depth assistance to borrowers in the greater Bay Area. We also, all of us, the 6 attorneys in the office, participate in many state and national consumer advocacy groups, housing counseling listservs and the like. So the information that I'm going to be presenting comes not just from our office and the volume of cases that we see there, but as well from the stories, questions, tearing out of hair that we come across on a daily basis, unfortunately, from these other sources as well. I want to say that I am here not just on behalf of HERA, but also on behalf of the California Reinvestment Coalition. CRC is an organization that has membership of groups throughout the state and has been, I think, a critical player during this crisis in terms of gathering and channeling input from housing counselors, consumer advocates, other groups and individuals throughout the state to gather data, information, and views and try to work together with the legislature and each other in trying to come up with policy solutions to the crisis that we're all facing. They've also been, I think, great watchdogs of both the industry and enforcement agencies and have been helpful in bringing information to light in that way. I think I'm going to use my time. I had some more general comments, which maybe I'll come to later, but I would really like, now that we've been here for quite a while, to bring some borrowers into the room. I work on a daily basis not only at the policy level and educating myself about HAMP and what's going on and trying to learn at this sort of macro level, but I do work with individual borrowers daily. Currently have a caseload of about 55. Last year our office saw about 1,300, counseled about 1,300 borrowers. We've done about 250 so far this year. That's ongoing cases and short counseling. And I just wanted to I guess, refer back to Senator Leno's question about posing the question about the person foreclosed upon who's in the loan modification process, because I would like to confirm that this does happen, and it does happen with startling and very disturbing regularity. I'm not claiming that every one of our clients has this happen. That is not the case, but unfortunately, I really don't think that these are outlier cases for the most part. And I'd like to share 2 brief stories with you just to give you a flavor of the kind of things that we've seen happen just in the past several months. Rosa L. fell behind on her mortgage after loss of some of her hours at work starting in April of 2009. She applied for a modification in the summer of 2009. She was ultimately approved over the phone in October 2009 for a Making Home Affordable trial plan, which is the initial sort of step that a borrower takes on the way, hopefully, to a permanent modification. She was told that she would be sent the documents relating to the trial plan. This was just a verbal assurance told by a customer service person. They set up, during that same call, an auto payment, automatic withdrawals for the 3 months of the plan that would last from December through February. Right after that, a notice of sale was recorded. She had, I should say, a notice of default right before she applied. And then before her making home affordable...
Was that a federal bank or a state registered bank, regulated bank?
Federal. Sure. I tried to do a range of them. So she was on the understanding that she was in this plan and that the payments would be taken out starting in December. In November, it turns out, later, her house was sold in foreclosure. She found this out in the beginning of December when she was served with an unlawful detainer complaint notifying her that she would have to leave the house. She went through a legal services agency that we collaborate with. She ultimately came to us, and when we started to get involved in December and January, we discovered a couple of things. The first was that notwithstanding the foreclosure sale in November, the bank had continued, or had started and then continued, to withdraw her trial payments in December, in January, and then again in February, even after they had been notified by us in writing of what had happened. We also found out that the extension of the initial Making Home Affordable plan had been in error, that the investor on this loan actually didn't allow permanent rate changes and that the only modification would be under a different program. This borrower has now been extended a modification because of the hours and hours of work that one of my colleagues put in communicating and making sure that money in the suspense account got applied. I mean, there were endless little problems beyond the obviously very large problem of them having foreclosed. Happily for her and for us, her foreclosure was rescinded. She's modified. She's back and on track and paying. But for several months, she was in this horrible post-foreclosure limbo, not knowing if she was going to stay in her house. And frankly, it was shocking to me how long it took to correct what was an incredibly obvious error. I mean, some things can be more subtle, but this was... and the fact that the departments don't communicate to each other and take payments, this is unfortunately quite typical. Second case, Patricia M. Her husband lost employment. They applied several times for modifications, never got responses, kept having to have their documents sent in again. During the summer of 2009, she was twice sent Making Home Affordable trial plans. When she called to confirm that everything was in order and start making her payments, each time she was told that in fact she was denied and it had been a mistake. She then reapplied completely in the fall of 2009, and by that time had gotten a notice of sale. She asked specifically, would the sale be postponed since she had a pending HAMP application? She was told yes, it would. The house was then sold the next month. Again, we have been involved for about 4 months now. The sale has still not been, I'm sorry, that's incorrect. The sale was just rescinded at the end of February, and notwithstanding the fact that she was twice approved for Making Home Affordable, they are now reanalyzing her modification application qualifications all over again. It looks as if she will get one, but it's unclear why they couldn't go back to the numbers they had originally used as the program requires.
Was that a state or federal bank?
I can tell you who it was, and I think it's federal, GMAC.
Okay.
Yeah.
The reason I'm asking the questions is just, my mind's working towards how do we do something about this.
Sure.
When you say federal, it breaks my heart because it's like, well, you don't have the regulatory authority. But, that's probably something we should have a discussion at some point with our federal counterparts on how to deal with those issues as well. So I just...
Sure. Well, just to address that, I do think there's still something because, the foreclosure process and timeline is a creature of state law. And I think that, as Senator Leno was alluding to before, that the idea of simply requiring that the process be completed, that somebody either be given the modification, have it confirmed and everything, or be denied and told why they were denied, because I will say that on a regular basis I find servicers miscalculate income, servicers have the wrong escrow numbers. There are many mistakes that lead to wrong denials, and we do want there to be built in some sort of process where the borrower can know this is why I was denied, and know they can go back and say, look, these are my numbers. I mean, I will look at the same pay stubs that a servicer has that the borrower submitted and find out that they've used net instead of gross, for example, the most basic error when HAMP requires that you use gross. If you use net, you have a much lower number and you're probably going to fail in terms of affordability. So if they're not even using the right numbers and then denying people, I think they need to at least have the opportunity to know that and correct it. In terms of the state intervention, I think that a very modest and perfectly within the state's jurisdiction kind of an intervention is simply to put a line in the sand and say, servicers, you need to complete the application process, you need to complete the review and give a denial with an explanation before you record an NOD. I won't go into, because of time, other examples that I have, but I do have several people who had a notice of default recorded during the time that they were under review and before a decision had been made, and ultimately got a modification. I could look at the numbers and see they were going to qualify, and there was no reason to record that notice of default. The costs of that, I would just like to emphasize, are not simply the costs of the foreclosure fees and all of those things. They're costs to the housing market, because the numbers of NODs go into how it looks, how the whole overall state housing market look, and every one that's unnecessary only adds to that. The other thing is that having NODs filed for people who should be getting modifications and can and will get modifications makes them increasingly vulnerable to scammers who go to the public records and see who has an NOD filed. And the servicers' sort of delays and all of the confusion and misinformation and conflicting information also drives borrowers to scammers, because they feel like they're not getting anywhere, and so the idea of paying someone some money to take care of this is very appealing, especially when the free services have limited resources.
And I'm very sorry, but
Yeah.
we're almost out of time for this panel as well. So.
Okay. I'd like to just say
Yes,
one
please.
final point.
And
I
wanna
think
hear from
that
Ms.
any...
Garcia as well.
Okay. Yes, one final point, which is I think that the goals of any kind of intervention, and I do think, as I say, the state has a role in this, are to increase the transparency, to increase the efficiency, and to increase the fairness. I mean, I just think that everyone involved needs to keep in mind that these are people, these are our neighbors, and everyone deserves to be treated fairly, told what's happening, and given an answer, yes or no, so they can understand before they lose a house what has happened and what went into that. Thank you.
Thank you. Thank you. Good afternoon, Madam Chairman, Mr. Chairman. I'm Norma Garcia, Senior Attorney from Consumers Union, the nonprofit publisher of Consumer Reports magazine. Thank you very much for inviting us to address you today on this very important topic. The first item of legislation I will comment on is SB 1137. That piece of legislation is a very important piece of legislation that Consumers Union helped pass. It's one that contains several key protections, and I'm going to limit my comments to the non-tenant aspects of SB 1137, particularly that piece of 1137 that requires mortgagees, trustees, beneficiaries, or authorized agents to use due diligence and to arrange a meeting with the borrower 30 days before filing a notice of default. Consumers Union has serious concerns based upon reports that we've received from homeowners inquiring about how SB 1137 works, that the law is actually being followed. One of the complaints I hear quite often from homeowners who are saying, how does this work, is that they're not getting a notice that they have a right to have a face-to-face meeting. And many of them are surprised when they hear that, in fact, this is what 1137 is supposed to offer them. In a couple of instances, I've heard from homeowners who have said that they were quite surprised by the declarations that were filed with the foreclosure regarding the attempts that the lender servicers said they made in order to set up the face-to-face meeting. And so I think there needs to be greater monitoring with respect to how this process is taking place. And so, what's needed? So particularly looking at how we can make things better, because I think that's an important emphasis of this hearing. More specifically, we need more specificity and information that's required to show due diligence efforts for the contact aspect of SB 1137. The servicer should be required to report data to their respective regulators regarding their results, and that data should be made available to the public. The regulators should be collecting the data and monitoring the results to ensure better outcomes consistent with the law's intent. I think also that the sunset date for SB 1137 is rather short. The sunset date is January 2012, and given what we're hearing about trends in foreclosure, it seems that it's only reasonable to extend that sunset date a little further. The other pieces of legislation that I'm going to comment on briefly are the 7s, SB X27 and AB X27. These bills were designed to incentivize loan servicers to develop and implement comprehensive loan modification programs to avoid unnecessary foreclosures by extending the time period before a notice of sale can be recorded unless an exemption has been granted. There's a few problems with what we're seeing with respect to these bills already, and that is that with respect to regulatory oversight, we need more detailed data for increased transparency. The orders of exemption that are posted on the websites of the regulators do not provide much information regarding the nature of the loan modification programs that are supporting the exemptions. Where the requests for exemptions are granted, as is the case in most, as is the situation in most, though not all cases, it's clear that the regulator believes that the applicant has met the requirements for good cause, but there's no way for any member of the public to know on what basis that approval is made. That information is clearly available if you look at the DRE website, the DOC website, and the DFI website. And we think that the public, as well as policymakers, could benefit tremendously by seeing more data so that we can figure out what the best solutions for fine-tuning the results here are. The most recent data from the fourth quarter of 2009 reported by the regulatory agencies is that there have been 193,263 workouts initiated, but only 77,919 workouts closed, representing basically 60% of those workouts initiated, which have not resulted in a closed workout. We need to know why more aren't working out. And the way to do that is to find out what's working and what isn't. And that really goes to the issue of needing more specific information about which exemption requests have actually met the bar and why. We'd like to offer a few recommendations. We think that the idea proposed by Senator Leonard regarding HAMP determinations before notices of default is a very simple and wise solution. We believe that the regulators should collect and make publicly available more data regarding the nature and quality of loan modification programs and loan modifications offered pursuant to the exemptions granted. We believe that they should collect and publicly report data explaining the reasons why only 40% of workouts initiated from the fourth quarter have resulted in a closed workout. We believe in extending the sunset on the 7s beyond January 2011. That's less than a year away. That we need more time to make sure that this particular legislation has a chance to work. We encourage more sustainable loan modifications with principal reduction, because that really is the way to keep people in their homes rather than creating the incentive for them to walk away. In conclusion, we thank you for this opportunity to speak with you on this issue, and we remain available to work with you in the future.
Thank you very much. And Ms. Garcia, I just have one closing question for you, and that is, you have stated that you're hearing from many people with regard to their opportunity to have their SB 1137 meeting or loan modification opportunity. Yes. And I don't know what sort of data you keep on that, what sort of information you have available that you could share with us, if there are any specifics you can give us. Sure. Names, dates, times, who the lenders are, et cetera. That would be helpful to us. So if you have that information, if you'd please share it with us, I'd very much appreciate it. What form do you keep that data in?
In notes. Yeah,
Okay.
yeah,
All
we
right.
keep a record, a log of the calls that come in, the name of the individual, the name of the lender, just general description of the facts as they report them to us.
Okay.
And in almost every case, we refer the individuals who call us to the regulatory agencies and encourage them to file complaints.
Okay, very good. Thank you very much.
Thank you.
Any questions for this panel before we, Senator Calderon?
Actually do have, yes.
And Senator Calderon, you're going to need to stick to 30 minutes on the next one.
Oh, just on my question? That's easy. I got you. You know, the reason for this hearing is determine whether or not this legislation so far is adequate and whether or not it's working. What I'm hearing a lot from, after hearing your testimony, that a lot of it has to do with some of it's regulatory in nature, some of it's interaction between the servicer and the lender, or the borrower and the servicer. I guess what I'd like to know is how low. When do we determine that this legislation's been successful? I mean, it's already been in effect maybe a year. We've got our numbers so far. We've seen some improvement, but we still have some bugs in it. But how low do foreclosure numbers have to go before we're all satisfied that borrowers, are getting every available chance to remain in their home? And is it a matter of existing legislation not being adequate, or has it got to do with the implementation of that legislation and the regulation of it? Anybody can answer that. Who would care to?
I will say, I think at this point, given the sort of changes on the ground that we've seen since the time that both of the pieces of legislation we're talking about were passed, that it is at this point inadequate to the task. I think that the problems that we're seeing have less to do, for example, in the case of SB 1137, less to do with the matter of making the initial contact, making borrowers aware of the option, because I think with HAMP and a lot of the publicity around that, it's not that every borrower knows, but the public awareness of that as an option has become greater.
But the legislation is requiring lenders to make that contact.
It is, and HAMP does as well.
The problem arises after that contact is made.
Correct. So what we're trying to look at is what are the ways to move the review process forward in a more transparent, fair, efficient way, and move the people who may not be able to avoid foreclosure forward and move through that, and move those who can get the modification to a modification so they can move on as well.
Go ahead.
Just in following up on that, if you could just very, very briefly explain why you believe the process that you've just discussed, how that does work, how that does help fix the situation, having the process happen prior. Just
having the review
briefly,
completed
yes,
prior?
Just briefly, why you believe that
will
have an impact
sure,
on a better process.
It is my understanding, from having heard responses and discussions from the industry side, that they are interested in being able to move forward with foreclosures when that is called for. So I think it is the belief that if that is what they want to do, that knowing that that can't begin until this review is completed will be an incentive where none currently exists in many ways to get the review process completed. We're not asking really for extra time. We would like them to complete the process and take people out of this limbo of uncertainty more quickly if possible. So we look at it as a way of motivating, I guess I should say.
Yes, please. Thank you.
Just to finish my questioning, Mr. Leonard, so how low do foreclosures have to go until we've decided we're actually making an effect on homeowners' ability to maintain their?
I don't think that we have a sort of a numerical bar to sort of offer you. I think that we to date have relied on voluntary efforts to urge and incentivize servicers to bolster their own capacities They've done that, but I think the reports are eminently widespread that they have not yet been sufficient in developing the kind of efficient systems to make sure that every borrower gets a timely, a fair shot at a modification. Clearly, you're not.
Everything that you're recommending, and our foreclosures maybe drop another 20 or 30%. Is that? I mean,
again, I can't give you a number here.
Obviously, because of economic reasons, and we're not going to get them all. So I'm just trying to find, where do we say, yay, we did a great job? I mean,
not yet.
Well, but we've only had these in effect for less than a year.
Is these being the HAMP program?
Legislation.
Well, I mean, again, I think that, the 800-pound gorilla is the HAMP program, and I think that's the one where it's a $75 billion program that was aiming to provide modifications to 3 to 4 million households. I think it's very hard to track the unique contributions of our laws relative to the larger HAMP program, and we don't really have a process now that provides for either individual or service or programmatic accountability so that we know that, in fact, all borrowers are getting a fair shot. Look, we're not saying people who don't have income presumably aren't going to qualify for a modification. And we have never suggested that. In the fact, the legislation that we're proposing would have absolutely no impact on the determination criteria that are used for evaluating for a loan modification. It's simply a process change to make sure that folks are getting a fair shot with some accountability before they find themselves in a foreclosure process.
Really no way to measure it.
We seriously believe that greater transparency and the reporting of data will go a long ways to increasing performance. That is something that can serve as an example for other lenders or servicers who aren't having such good results. They can see what's working, and so can the public, and so can the regulators.
All right.
Agree.
Thank you very much. I think we've learned a lot from this panel as well.
Thank you.
Next panel, Mr. Calderon.
Great. Yes, I will take this part of the hearing, and that is to have our lenders approach. We have Brian Bolton with he's the Senior Vice President with loss mitigation of City Mortgage. Brian Finch, Vice President, JP Morgan Chase. Mike Kimball, Government Relations Manager, Bank of America. Brad Blackwell, Executive Vice President, Retail National Sales, Wells Fargo. We have Melissa Amaluxon, who is the Director of State Government Affairs for the Credit Unions and the Credit Union League, and Mike Belote, who I'm going to ask to speak first, with the California Advocates representing the United Trustees Association. Everyone, we have 30 minutes to get this done, so please try and be effective with your time. Mike?
Thank you, Mr. Chair, Madam Chair, members. Mike Belote for the United Trustees Association. I'll take just a couple of minutes and talk about the context of SB 1137 and some of the impact of it. One of the housing advocates mentioned, and is absolutely correct, that the foreclosure process is entirely a creature of state law. The non-judicial foreclosure process is entirely a statutory creation. There is no common law non-judicial foreclosure. The entire process for conducting a non-judicial foreclosure is laid out in the Civil Code, and it's very, very precise. It must be complied with precisely, or legal remedies will attach. The trustees are involved in conducting the foreclosures and have been working to implement SB 1137 in a very precise way. Of course, as Ms. Garcia indicated, there will be slippage, there will be failures to comply, but we believe in the vast majority of cases the lenders, servicers, and trustees have worked to implement SB 1137 because the penalty for not is litigation. And that's where I wanted to go first. When we negotiated the principles of SB 1137, we worked very, very hard in good faith with all of your staff to create a product that was objective and verifiable, That is, it would be clear when compliance had occurred and when it hadn't, because of the problem of litigation. Since the implementation of SB 1137, there has been a very, very substantial body of cases challenging various parts of SB 1137 because despite all best attempts, there are ambiguities in the statute, and every word in the non-judicial foreclosure process is litigated. And I'll give you 3 examples with respect to SB 1137 very quickly. One question that has raised dozens of court cases is whether the declarations involved in SB 1137 need to be under penalty of perjury. I thought it was quite clear in the law that the answer was no, but in fact that principle has led to lots of litigation. Usually the lenders and trustees have prevailed and the foreclosure has ultimately gone forward, but that has taken lots of time and money in both state and federal courts. The second was a contention that SB 1137 actually contained an affirmative mandate to modify loans. We didn't think that was the case, but that was raised in a number of cases, and that has been litigated as well. The third example is where there have been questions about the interaction between SB 1137 and federal bankruptcy law. Very, very technical questions that have been raised. And finally, I would say there have been lots of cases filed where they just have misunderstood the basic terms of the statute. There have been cases filed concerning properties that weren't covered by the statute because of when the loan was made, for example. And those, again, the trustees and lenders in general have prevailed, but it's taken time and money to handle the litigation. And I guess my message to conclude would be this, Senators. The beneficial part of the non-judicial foreclosure statute is precisely that objectivity, the verifiable nature of what is required. If, to the extent that you build in ambiguity, then you invite litigation, and what that results in is an encouragement for lenders to resort to judicial foreclosure instead of non-judicial foreclosure, which we think is bad for lenders because it drives up their costs, to borrowers because it drives up their costs, and because it'll tend to fill up the state courts with foreclosure actions. So as you evaluate potential options going forward, we would urge you to continue to work to make the process as objective and verifiable as possible. Whatever you require, we should all work very hard to eliminate that ambiguity. And I know I'm not here testifying on any given bill, but I'll just give you one very, very brief example. SB 1275 by Senator Leno uses a phrase, meaningfully participate. In other words, it conditions the ability to do the foreclosure on whether there has been meaningful participation by the lender in the workout program. And it's those sorts of phrases that will invite litigation. So whatever you do, we would encourage it to be, like I say, objective and verifiable so that it's clear how compliance can be achieved. So we avoid the litigation, which ultimately leads to an encouragement of judicial foreclosure. Thank you.
Thank you, Mr. Belote. Mr. Leno, if you would like to respond to that, I'll allow you, because we were not supposed to bring up any future legislation in this hearing. So are you okay? Okay. Good point. Okay. Great. Thank you, Mr. Belote. I'm going to ask Melissa Emilixson to testify at this time. Thank you.
Great. Thank you.
Please be brief.
I will. Thank you for allowing me brief as possible. Brief testimony today on behalf of the California Credit Union League and our 400 state and federally chartered credit unions. We represent a smaller slice of the real estate market. We have $51 billion in real estate loans, and by and large, the majority of those loans are owner-occupied single-family residences only. And to be honest, during the passage of SB 1137 and the foreclosure moratorium, we were really worried. The credit union community as a whole was worried. Because most of the time when we talk about these bills, we talk about them and their effects on the big banks and the borrowers borrowers that borrow from big banks. But in reality, you have hundreds of state banks and hundreds of federally chartered financial institutions in California that are really small, that are complying with these statutes every day. The extra 90 days on foreclosures, that's straining for us. Additionally, the costs associated with SB 1137, whether it be certified mail or hiring a landscape company, websites and toll-free number maintenance, door knockers, etc., all are added significant costs to our institutions. Our foreclosure rate is still really low, 0.3%, but the costs imposed to us during the process are pretty high. Credit unions, as you heard from Ken Sayer-Peterson, are complying with these laws. As far as timing of notice of defaults, prior to the foreclosure moratorium, credit unions actually had the flexibility to send notice of defaults out, 6 weeks, 2 months. Before they do now. It's because when the notice of default is sent out, the clock starts ticking, and then you have the 90 days an additional time frame. So, before the foreclosure moratorium, we would, by and large, let borrowers go beyond the 30 days delinquent. But now, because of the sevens, we're moving a little faster. There are about 34 credit unions right now that have approved loan mod programs through DFI, and they're exempt from the moratorium. So, by and large, the majority of credit unions are complying with the 90 days. That's not to say they're not modifying, though, at significant rates. The time to record a notice of sale has obviously increased. We're worried about any changes to that time frame for notice of sale, because the notice of sale, that red circle on the calendar, gives borrowers and lenders the incentive to compromise and come to a resolution. If that notice of sale date is fluid, it changes, it can be flexible, then you kind of don't have the hammer with the lender and the borrower to make decisions, compromise, and resolve mortgage lending workouts. Credit unions have modified over 80% of delinquent real estate loans this last quarter. In some cases, individual credit unions have more modifications than delinquencies, meaning we're modifying a significant amount of loans before they even hit the NOD process. Credit unions, again, our modifications have increased dramatically. We only have 28 credit unions in the United States that participate in HAMP. So when we talk about state legislation and needing to get HAMP numbers or using HAMP as a qualifier, it doesn't work for us. We don't participate in HAMP for a number of reasons. It was really developed by the FDIC. We're not regulated by them. We don't care about the financial incentives associated with it. We didn't take TARP money, so we don't have to participate. And quite frankly, a lot of our credit unions say they're doing better than HAMP. So we don't prescribe to that program. Also, credit unions, their modifications are proving to be very successful. There's currently only a 22% recidivism or redefault rate for our loan modification, so it's pretty low.
And what is your loan modification record now?
It's 80% of delinquent.
80%, and of that 80, 22%
are redefaulting. Yeah, so we think that's a pretty solid number. Matches unemployment.
Right.
If you really look at the numbers. So in closing, as an industry, we feel a little beaten and bruised, and we're not out of the rough times as far as financial institutions. Delinquencies have risen on a number of different kind of products, but virtually all the foreclosures and financial hardships we see are because of job loss or circumstances related to job loss, like divorce or decline in health or unfortunate problems like that. So we think kickstarting the economy is really the way to solving a lot of the state's housing woes. So with that, I will close.
Great. You're not the only ones being beaten bruised.
Yeah, I get it.
Homeowners are getting beaten bruised, and so are we. Next, I'm going to ask Brian with City Mortgage. Why don't you go ahead and
Okay. I thank the committee for inviting me here today to let us tell a little bit about our story and about some of the things that we do. I'm going to make just a brief statement and then open it up for what questions you may have for me. My statement is going to touch on some of the things that I think that have been talked about by the various groups. Like a lot of the other servicers that are at the table, the city has had a foreclosure prevention program in place long before this crisis. For well over 10 years, we've offered modifications to borrowers. We've done it proactively if they're in imminent default or if they're at any level of delinquency. We offer free credit counseling to borrowers. If they don't feel comfortable contacting us, they can go to a credit counselor and talk to them. The key to anything with a borrower is the communication with the borrower. I know a lot of legislature that's been passed has been driven around, quote, forcing lenders to reach out to borrowers. Well, that's a discipline that we've had in place for a long time. We do a lot of different communication strategies to try to reach borrowers. They include, obviously, phone calls. We send letters. We send free to the end user text messages. We send emails. We go out and we will knock on their door and ask them to talk to us. We will leave a note in a sealed envelope offering them to call us or to call for free credit counseling if they're not comfortable reaching out to us directly. In addition, we will go out to communities along with other servicers and invite them to come meet with us, like at a convention center, things of that nature. In fact, we were just in Sacramento, I want to say about 2 weeks ago. All the servicers were here. One of those days was centered around collecting documents for HAMP, and we scanned those documents at the event because there's a lot of talk about losing documents. So we feel we've done a lot of things to reach borrowers. We don't reach everyone. We wish we would. When it comes to our results, I've heard a lot of talk today about transparency. I think we're very transparent in our results at Citi. For over a year now, we have released quarterly reporting on our foreclosure prevention results. We can get a copy of that to the committee today or tomorrow. The fourth quarter is going to be released today or tomorrow from us. It's a lot of key statistics in there. It has national information. It also has state-level information, which California's included. I think some of the key sound bites from that would be for every borrower that loses their home to foreclosure sale, there are 15 borrowers that we find a home ownership retention solution for. That's our number nationally. That's also our number here in California. I think you hear a lot of talk about the subprime market. In California, for every borrower that loses their home, there's 27 borrowers that we save in that subprime space. So I think we do a very good job at that. I think, again, we do a good job of reporting that data and welcome questions around it. The Treasury reports monthly. It's a scorecard on all the servicers on how well they're doing on the government program known as HAMP. We are the number one of the large servicers for putting borrowers into the program. We're number 2 overall. We have 52% of our eligible borrowers are in the program. We certainly are looking to put as many of those borrowers into permanent modifications that meet the guidelines of the program. It was reported yesterday that our modifications went up over about 5,000 month over month of modifications. So we have over 15,000 HAMP modifications. But the one thing that doesn't get reported is the number of non-HAMP modifications that we do. So we did about another 5,000 non-HAMP modifications in the month of February. So in essence, our total February modifications, including second liens and first liens, was pretty close to 11,000 modifications nationwide. So we feel we do a very good job. We're very proud of our results, but we're not satisfied with our results. We know that we need to talk to more borrowers. We continue to try to find ways to reach out to those borrowers, to get them to reach out with us. We know, as you've heard some horror stories today, we make some mistakes. Sometimes borrowers call us and we don't do a very good job with them. Maybe we don't document the account with what happened. Maybe we don't stop a foreclosure sale. But when we make mistakes, we fix those mistakes and try to put the borrower into the best solution that we can. So with that, I'm going to wrap up my statement and take any questions you may have.
Questions? Senator Corbett, did you have a question?
Thank you very much, Senator Calderon. I actually don't have a question at this point, but I'm very sorry that I am going to have to leave for something else, and I'm sorry I'm not able to be here in person to watch the rest of the presentation, although this is being taped, and I will certainly watch the tape. And since this isn't the end yet, I did, though, want to take an opportunity to just thank all of the speakers that were here today. I think it's very, very important to hear from all sides on this. I think we've learned quite a bit, and Senator Calderon and I had a little bit of a sidebar here and how happy we are that we've had the opportunity to hear from all sides today, and that as we continue to sort of go down this rocky road as we deal with the foreclosures in our economy, that I think it would be great to have an opportunity to get people back together again and talk about our progress, how things are going, and what we may need to do or tweak to continue to try to keep people in their homes. So I just quickly wanted to thank you for all of your participation. I'm sorry I'm sort of interrupting in the middle of this, but hopefully we will see you again soon on this as we continue the discussion. Thank you very much.
Great. Thank you, Senator Corbett. We're going to continue on now with oh, thank you. We're going to continue on with our J.P. Morgan representative. That is Brian Finch.
Thank you.
If you don't mind. Oh, there you are.
Thank you. I'm Brian Finch. I'm Vice President for Government Relations and Public Policy at J.P. Morgan Chase. I'll try to highlight some key points, data, and analysis that I think would be helpful to today's discussion. Just as basic background, HAMP is the centerpiece of Chase's foreclosure prevention plan. For customers that are not eligible or do not qualify for HAMP, Chase offers its own proprietary modification plan, which offers greater latitude in product features and eligibility. Regardless of the modification program, Chase uses a combination of automated tools and standard underwriting policies to provide borrowers with a reliable and consistent evaluation and resolution. And in every case where our analysis indicates that the loan MPV just doesn't support a loan modification, Chase has implemented an independent review before a loan goes further in the foreclosure process. This acts as a control to ensure that all appropriate actions have been taken. Additionally, there's another review that happens prior to any sale. So this is intended to help prevent any occasion where a sale might happen and it was not appropriate. So let me just touch on some of our results here in California, specific to California. From 2007 through last month, we've helped prevent 188,667 foreclosures in California. So as of February 28th, Chase estimates that it services 89,699 California loans potentially eligible for a loan modification under HAMP guidelines. Out of that population, Chase has offered 79,408 modifications to California homeowners. Out of that population, Chase has 51,008 California homeowners who are in active trial plans. And those plans.
How many of those are permanent mods?
Well, so none of those are permanent yet. And then additionally, 5,211 California homeowners have so far converted to permanent modifications. So we send out an average of 4 letters to the customer from the time they go delinquent until the notice of default, and that includes the due diligence and the outreach required of SB 1137. And we begin placing phone calls to customers as soon as 6 days delinquent based on our risk indicators. Over a 4-month period prior to filing the notice of default, we could place approximately 120 calls to a borrower. And obviously, if there's contact, the number of calls will decrease. So a significant challenge continues to be converting trial modifications to permanent modifications. What we're seeing is that for every 100 seasoned HAMP trial plans initiated.
Trial modification, could you explain to us exactly what that is?
So the trial modification is kind of the basis of HAMP. And so when someone is interested in getting a trial modification, we will put them through a 3-month trial, and where they will be required to make their payments. And historically, during that time, we gather their documentation and will basically re-underwrite that loan, trying to move towards getting them into a permanent.
During that trial period, is it possible that they will receive a notice of default?
Yes, so I believe so. Yeah. So the process will move forward, but we would never foreclose on a loan while it is being reviewed for a modification. So, but that does not entirely stop the timeline.
Okay.
So what we're seeing for every 100 HAMP trial plans initiated, 25 customers do not pay as agreed, 75 pay as agreed, and of those 75, 29 do not submit all their documents required for underwriting. 13 are not HAMP eligible, but they'll be eligible for the Chase modification program. And then 33 are able to be underwritten. So document collection continues to be a major challenge. A lot of customers just aren't sending in, or are sending in forms that they haven't signed their name, or they haven't provided a social security number, or they don't return one of the 4 required documents, which are the hardship affidavit, the request for transcript of tax return, the W-2, and a pay stub, or pay stubs. So to ensure we're doing everything possible to convert those borrowers from the trial plan to the permanent modification, we call a customer 36 times. We reach out by mail 15 times, and we make at least 2 home visits to get the appropriate documents.
How long do you give a trial candidate to provide all the information you need before you go to the next level?
I don't know the answer to that. I can find out. I know up to this point it's kind of been open-ended because Treasury has really been encouraging us to get to that permanent point. So we've been very hesitant, if they've made the payments, to not close the door on them.
Sure.
So a recent analysis of our modification results presents what I think are some interesting findings. California has had a higher success rate than the rest of the country in terms of Chase customers in trials. 64% of eligible customers were made HAMP modification offers. Chase's national average is 53%. And between HAMP offers and our proprietary program, 89% of all Chase borrowers were made trial modification offers versus a national average of 73%. So that's 16 percentage points better than the rest of the country. And I think what that shows is we're getting trial mods into the hands out of 9 out of 10 borrowers who are potentially eligible for a loan modification. We suspect several factors probably contribute to these better than average results. One, we credit California government with its early and organized effort and recognition. As one example, in late 2008, the California Department of Real Estate approached Chase about partnering on a major statewide outreach initiative called Project Homeowner. Chase fully underwrote a series of grassroots mortgage counseling events throughout the state. With DRE's leadership, we collaborated very closely with various minority and trade associations, private business owners, and local churches to reach thousands of struggling homeowners. Second,
excuse me, of those borrowers that are not offered loan modifications, how many of them are offered short sales?
I don't know the answer to that. And a short sale, I'm not sure it's really, it's always an option for them, but you need to find kind of the short sale match, the buyer on the other end.
When you say it's always an option for them, is it an option for them when you offer them the loan mod? Is it also, do you also offer them a short sale at the same time, or you do the loan mod process first?
Yeah, so we'll talk with them about the full range of options. And if
they say, I don't want to do a loan mod, I want to do a short sale, you'll do a short sale?
Sure. It's got to work through that process, but yes, we would definitely explore that with them. And if they fall out of the loan modification process, say weren't eligible or didn't keep up with their trial requirements, we will then, in that independent review, contact them and speak with them about the other options. So that's the short sale and the deed in lieu.
Okay, thank you.
Second, I was just going to point out why we've got these strong results in California. We've got a really strong and unmatched network of community groups in the state who've engaged on this issue and implemented very localized responses. We think this has really helped. In the last 12 months, Chase participated, sponsored, or helped organize 163 foreclosure outreach events in California. That's more than a third of our national total. And then finally, as a company, Chase has focused significant resources on California, and we've done some outside-the-box things in the state. We've opened up these Chase home ownership centers where a borrower can walk in the door and talk face-to-face with us about their situation. We opened 9 of those centers around the state last year, and we'll have another 7 open by the end of this month. Those are in Northridge, L.A., Long Beach, Riverside, San Bernardino, San Diego, and Walnut Creek. I guess I'll just conclude by saying we recognize this has not always been a smooth process for homeowners. I've heard the same complaints that I know a lot of you have, particularly around lost documents or needing to resend the documents. I guess, I would just say last year the rules of the road and the options available to homeowners were continuing to evolve and often in flux. We think that was over time to the benefit of the consumer. Mm-hmm. So in some cases it made sense to continue the process along, and if we had to go back and ask for updated documents, that was in their interest. And it was not until roughly 6 months ago that we really had the final regulations for implementing HAMP. So really not that long ago. In the meantime, we've continued to build capacity. We've hired thousands of more employees to deal with this issue. We have approximately 14,750 employees who are dedicated to loss mitigation around the country. We've also integrated two major companies, Bear Stearns and Washington Mutual, during the financial crisis. Now all documents are imaged upon receipt and saved electronically so they don't get lost.
As far as you know, your company is in compliance with the 7s and 1137?
Yes, absolutely.
Okay. You had a question, Senator Cox?
I do. And thank you all, by the way, for your testimony today. I wanted to ask Brian a question, if I may. Is your procedure the same on all real estate loans, or are you just talking about residential homes?
I've only addressed residential loans.
So you're not talking about the process for anything other than just residential homes?
Not right now, correct.
Generally speaking, is it the practice of your company, though, to provide information for borrowers so that they might have the opportunity to communicate with someone and reach a decision relative to a loan which was considered to be outstanding?
We will always, it's our practice that we will engage a borrower and we want to have a discussion with them.
And what does engage the borrower mean, Brian, just so that I understand what you've said?
Sure. Well, we want to have that. We want to understand if a borrower is having
If you had a situation
difficulties.
where the person who they were talking to wouldn't give their last name, would you consider that to be a violation of your company policy, or is that just a method of keeping that person from receiving any kind of calls that might be threatening?
Yeah, I don't know our practice around that. I can find out for you.
All right. Is it a situation that you have taken all of the loans from Washington Mutual and brought them over to your company with the thought that once they leave Washington Mutual, they are the responsibility of Chase as opposed to being the responsibility of Washington Mutual when they're not brought into your portfolio?
It's my understanding that, once we acquired Washington Mutual, those loans were our responsibility.
Then the liability became yours and was no longer part of the transaction that assisted you in acquiring Washington Mutual.
Well, so when you're addressing the liabilities, that's probably a more complex question, and I'll stay away from it.
Fair enough. I appreciate the fact that you may not know the answer. With respect to the comment that you made about the residential homes, I want to be sure I understand this, because I thought what I heard you say was that you initiate some 36 letters or telephone calls during some period of time.
So that is our strategy when we've been unable to collect the documents to perfect the transitioning a loan from a trial modification to a permanent modification.
Would it be reasonable to think that that's the kind of practice that you have relative to all loans, that you have a policy and a procedure in place that puts you in a position of Chase always communicating with the borrower?
I would think we probably don't call every customer on other products 36 times.
Okay.
Does that answer your question?
That's really the hallmark of your operation, though, and that is that you pride yourself in communication, correct?
Sure. We pride ourselves in good customer service.
Okay. So. All right. Thank you, Mr. Chairman.
And
I
if we've
appreciate it.
not done that, would be happy to.
Thank you. With that, we're going to move on to our next speaker. Mike Kimball, you ready to go? Okay, let's go.
Good afternoon, Mr. Chair and Senators. My name is Mike Kimball. I am Government Relations Manager for Bank of America for California. I appreciate this opportunity to come before you today to talk about our ongoing home retention efforts. Over the past 2 years, Bank of America has helped more than 760,000 customers with a home loan modification or trial modification under the federal government's HAMP or one of our own proprietary home retention programs. That includes more than 500,000 modifications through our own programs, in addition to nearly 21,000 completed permanent modifications and nearly 240,000 active trial modifications under HAMP. We have a strong pipeline of modifications currently in the trial payment period that are undergoing ongoing review for conversion to permanent status and currently have over 22,000 awaiting final customer signatures. One of the most significant challenges that we face in the trial to permanent conversion process is obtaining all the necessary customer documentation. Special efforts to encourage and help customers return required documentation, such as face-to-face outreach and targeted priority mailings, have improved the document collection process and customer response. By the time our trial modification participants reach their HAMP expiration date, Bank of America will have made about 10 reminder phone calls and sent at least twice a summary of required documents and a postage-paid express mail package through which they can return their documents. For those customers who end up not qualifying for the HAMP program, we will still work to evaluate these customers for a modification through our own proprietary programs. Another significant challenge that we face is that many customers have experienced a significant drop in family income, make it increasingly difficult for them to find acceptable home retention solutions. We are continuing to look for ways to partner with policymakers to identify solutions to help customers experiencing temporary loss of income. It is important to note that Bank of America is not proceeding with foreclosure sales for customers who may be eligible for a modification under HAMP or our other modification programs, and with whom we have been able to establish contact. Those holds remain in place during the time that it takes us to evaluate the borrower and through the trial modification period. We have dedicated substantial resources to our home retention efforts, including the expansion of our default management staff to 15,000, a 62% increase over January 2009. In 2009, we participated in approximately 250 community outreach events to assist distressed home borrowers. We have also partnered with 3 national nonprofits, the National Council of La Raza, the National Urban League, and the National Council for the Asian Pacific American Community, in the creation of the Alliance for Stabilizing Communities. Our funding support is enabling this coalition and its members to hold 40 home rescue fairs nationwide in the 24 communities hardest hit by the foreclosure crisis. Thus far, 3 such fairs have been held in California, with another scheduled for April in the Central Valley. While we continue to focus our efforts on keeping our customers in their homes, we recognize that some homeowners simply will not be able to avoid a foreclosure. Therefore, we are also developing programs to assist the occupants of these homes, whether they are the former owners or tenants. While we have made significant efforts to assist our customers, we recognize that there is still room for improvement. High demand, on average more than 100,000 calls a day, has challenged our ability to deliver the world-class customer experience that is our goal. We have built a process that can more effectively handle the volume and complexity of these programs, but we understand the ongoing frustration our customers have faced. We continue to critically look at the modification program and are listening to customers, consumer groups, and other stakeholders on how we might be able to improve. In conclusion, we do understand the urgency of working towards solutions, and we will continue to pursue initiatives that increase the number of customers receiving assistance, enhances the sustainability of the loans, and improves the experience for our customers throughout the process. Thank you, and happy to answer any questions.
Over this subject. Now going to move on to Brad Blackwell, who is the Executive Vice President of Retail National Sales for Wells Fargo.
Thank you, Mr. Chairman, and members of the committee. My name is Brad Blackwell. I'm the National Sales Manager for Wells Fargo Home Mortgage. I have been in the mortgage lending business for over 26 years, and more than 20 of that have been here in California. So I want to talk about three things. I know this thing's going long, so I want to try to hit the high points for you. But I want to talk about the approach that Wells Fargo is taking to this issue, the results that we've had, and then our foreclosure prevention efforts, as well as commentary on the legislation that you asked us to address. First, our approach. As you know, Wells Fargo is based here in California, and we have probably more stake in a healthy, vibrant California than any other institution. We have 56,000 team members in the state of California, 1,500 locations, and 1.2 million mortgage customers. We contributed more than $50 million to nonprofits in the state of California, and our business model is one that doesn't allow us to sell a single product to a customer and be successful. We need to satisfy all their financial needs. So that's a mortgage, a checking account, savings accounts, business loans, all of those to be successful. So it's in our best interest to do everything we can to help our customers stay in their homes. So as such, we took a little bit of a different path. Wells Fargo never did and doesn't today originate negatively amortizing loans. We created a set of responsible lending principles over 6 years ago, before all of the go-go days of the mortgage industry began, that included things like we wanted to know the borrower's ability to repay the loan. We wanted to offer them prime pricing if they qualified, and we wanted to make sure all terms of the loans were transparent to them. Now, I can tell you, I led my organization during that period here in California, and we lost a substantial amount of market share as a result of these principles, but we felt it was the right thing to do. We also have responsible servicing practices that we've lived by for many years, and those involve timely information to consumers, tools, products, and services to help them with their finances, and obviously doing everything we can to keep people in their homes. And because of that, Wells Fargo's, because of those two things, lending principles and servicing principles, Wells Fargo's delinquency and foreclosure rate is 25% lower than the industry average and the lowest of all of the major servicers. 91% of our customers continue to make their payments on time. Now, when we talk about California, that's been a challenge. The California market has had decreasing home values, all the things that you've been wrestling with that have made California a challenge, unemployment, underemployment. Over 90% of our 1.2 million California customers are paying on time. And of the 10% are delinquent, 59% are working with us and are engaged in a workout option. And we only, throughout 2009, were foreclosed on 2% of the borrowers in our portfolio. Now, that's far too many in any circumstance. It's fewer than we would like, but it is much better than what the industry has experienced. Personally, I'd like to see that number at 0. Importantly, of those foreclosures, 39% of them were either non-owner occupied, already vacant, or were we were unable to make contact with the borrowers, and that's been few and far between these days. So this question of how do we prevent foreclosures has been a moving target. It's been dynamic. It started out, as the committee was addressing earlier, with the subprime issue, and it's moved today into unemployment, underemployment, lack of income changes, and that has required us to make many changes and evolve our foreclosure prevention efforts. We've added 9,000 people to foreclosure prevention in the last year and have 16,500 people in place today. So let's talk about the bills. 1137 was premised on contacting customers and making sure that you contact them prior to foreclosure. I want to say we are absolutely in compliance with 1137, and not only that, we have put in many efforts to try and do what we can to demonstrate not only that compliance but to reach customers. And I want to give you some examples. Yes. Oh, yes. Good. You want to wait? Okay. But I will say we are doing everything we can to reach borrowers, and today well over 90% of the borrowers that are seriously delinquent do make contact with Wells. So in the moving target category, it used to be, I think Senator Calderon, you made this comment earlier, over 50% of the people that were foreclosed on never had contact. That's not the case today. We are talking to customers thanks to many of the efforts of the state, federal government, as well as lenders' efforts. Now, some brief just examples of outreach. We are holding 2 major home preservation workshops in California upcoming. I just wanted to talk about those. At the Los Angeles Convention Center, starting this Sunday, we're going to hold a 3-day event, end of April in Oakland, where we'll bring in over 200 Wells Fargo team members. They'll be on site to meet face-to-face with customers who are facing problems. We're mailing letters, invitations, media as well, to do everything we can to let people know. We already have over 1,000 people signed up for the Los Angeles event, and we expect to help 2,500 to 3,000 people right there at that event next week. We've done these in other states, and so far we've reached 7,000 customers, and of the 7,000, we're able to actually provide a solution for half of them on the spot or within a couple of days after. So these face-to-face interactions have been very, very effective. We also have opened home preservation centers. We have 14 in the state of California. These are locations where we can mail or phone customers and get them to meet face-to-face with us. Chase talked about that a little bit as well, that they do this. We have locations in Antioch, Bakersfield, Campbell, La Puente, Lathrop, Long Beach, Novato, Oceanside, Riverside, Sacramento, San Diego, San Fernando, San Ramon, and Santa Ana. So you can hear that we've covered the state well so that everybody's within close driving distance and can see us face-to-face if that is necessary. Now, with regard to the 7s, the moratorium bills, this is one that said that we should be making a credible effort to modify borrowers' loans. And I just want to give some examples. First place, we believe we're fully in compliance with this law, and we believe that the things that we are doing are really innovative and different. And I wanted to talk a little bit about Wells Fargo's pick-a-payment portfolio. Wells Fargo never originated a negatively amortizing mortgage, but by a twist of fate and one stroke at the beginning of 2009, we acquired the largest portfolio of negatively amortizing mortgages, the Wells Fargo Pick-a-Pay loans, approximately $100 billion, approximately 60% that are in California. So I just want to talk to you about what we've done. Within days of getting that portfolio, we began aggressive outbound mailers with offers to modify borrowers' loans, not just offers to call us, but offers to modify borrowers' loans. In 2009, we completed more than 52,000 full-term modifications on what we call our mortgage assistance program. It's a very aggressive modification program for borrowers. In total, 60%, however, in California. Through the program, we've reduced payments for 97% of those customers. On average, we've reduced payments 25%. And we've accomplished this through a combination of interest rate reductions. Remember, these pick-a-pay loans or these option arms had payments that were less than the fully amortized rate. So lowering payments is a very challenging thing to do, yet we've been able to do it. Interest rate reductions, term extensions, and principal reductions. We have forgiven over $2.6 billion in principal on the Wachovia Pick-a-Pay portfolio, and that principal reduction has been approximately 15% of the balance of the loans that we've modified. So all loans are underwritten, and our redefault rate on these loans are running approximately half of the industry average for pay option arms. And I also want to make a point that 40% of these modifications happened as a result of outreach efforts that we made, not people calling in saying they needed help. There was commentary earlier about these pay option arms having recast and that these may be causing problems in the very near future. I'll just put to rest some of that analysis isn't fully accurate. The Wachovia Pick-a-Pay loans are very few are scheduled to recast in the next 2 years because they had a 10-year recast on them. So only 283 loans are expected to recast in 2010, and in 2011 only 245 loans will have a recast. So this problem is not a major issue for the Wachovia portfolio. And the last thing I want to address here before questions is that this issue of modifications has been a challenging one, and it was not something that servicers had historically done in a large scale way. And what we have learned is that this is much more like originating mortgages than it is dealing in loss mitigation, historical loss mitigation efforts. So something that Wells Fargo has done recently is we begin to transfer major origination centers, processing centers that have traditionally been used to collect documentation and underwrite new mortgages, and taken those skills and applied them to modification efforts. And we are seeing a tremendous improvement in the way that we're handling modifications as a result of those efforts, and you'll see more of that to come. Yeah, I just want to say and reiterate, there is no financial services company that has more invested in California than Wells. We are very interested in making sure that everyone that wants to stay in their home can stay in their home. And hopefully some of the things, the efforts with the Wachovia workshop, the outreach we've done with the home preservation workshops and home preservation centers, and our aggressive contact approach will demonstrate some of those efforts. And thank you very much.
Great, thank you. Senator Leno, you wanted to ask a question.
Thank you, Mr. Chair. For each or any of the lenders to respond, for those homeowners who are in the process of loan modification and are denied, do you have a system in place where a homeowner would get a detailed explanation as to why the loan has been denied?
Yes.
You do have. What kind of detail? What kind of detail do you provide?
It is. It's an explanation. To be honest with you, I'm not familiar with the actual paperwork. I'm on the origination end of this, but I do know that we give an explanation to the borrower of why they were denied. Generally, it's because there's either too much income to qualify for one of the modifications, or not enough income to sustain the home regardless of any effort that was taken.
You don't know if you get into the detail of net present value and other such calculations?
No, not with the customer.
But your question is, do they give them a reason why they were denied?
If there's a system in place for that.
Is there anybody represented here today that does not give a reason why the loan mods are denied?
I'd also like to know what kind of detail.
My understanding is that Treasury put out a directive last year relative to HAMP that provided a template that servicers generally use, and we can provide that to you after the hearing.
Is it all written? I'm sorry.
No, go right ahead, please.
Is it all written explanations that's sent to the borrower as to why their loan mods are denied? And if it's not?
Yes, it's sent in writing, and then there's a list of reasons, and then you check the applicable reasons on the adverse action, and then the borrower has the ability to appeal that decision.
Because Mr. Leonard had addressed that concern that the lenders are not providing that information to.
So the federal government requires you to go through a checklist and just check off
the applicable reasons for
then
why
my question
they do not
would be,
qualify for the modification.
Does anyone go beyond that which the federal program requires so that they could actually see what the calculations are?
No. When we talk about the calculations, right, there's a couple of different calculations. From the income perspective, I think it'd just be onerous for any servicer to try to take it down to the individual level to say, we calculated your income this particular way, right? It's never happened on the origination side of the house. Adverse action is brand new to servicers. Historically, we were not required to do them. It's approximately, say, 6 months old or less. So we're still working our way through that process. You mentioned the NPV turndowns. The challenge, we can say that it didn't meet the NPV model, but the challenge is around, if you want to give details around the NPV model, there's a lot of different attributes with a lot of different weights to it. It's usually not just you fail for a reason. It's usually 4 or 5 reasons. It may be, part of it may be your FICO score, part of it may be your risk of redefault, some of it may be your equity. So there's a lot of different things that go into there. I think all the servicers right now, we're still getting our feet comfortable with this process, and if we're asked to do more by Treasury, we'll certainly look to do that, but it would be very, very hard for us to implement it at this time because it's detail that servicing systems traditionally don't hold that information like an origination system would. And I think what we do is consistent with what originations has done in the past.
Melissa, you wanted to add something to that?
Sure, I only know anecdotally because I don't know for 400 credit unions, but my folks have told me it's similar to when you deny just a loan application, like a car loan, where they're giving the borrower the same data. But oftentimes it's a CEO of a credit union that's picking up the phone to call the member, and we just be worried from a staff level, a small financial institution, do we have the ability or the time or the people, resources to go through 10, 12 different quantifiable, I don't know the answer to that.
Thank you.
Okay, I would still like to explore. You're saying at this time it'd be very difficult to do. I'll give you that, but I would like to explore, in the near future, maybe something we can give them in writing. Because if someone goes to another lender that says, well, they couldn't give you a loan modification, but I can refinance you. At least if they had the reasons as to why they were, why they were turned down, and they could deal with a new whoever the agent is and say, well, if this is a problem, then how come you can do it and they can't? But at least it gives them something to look at and say, okay, well, I have something to go to go by from here. Again, I don't know the difficulties involved. But I know as a borrower, as all of us would like to know why we're turned down, and when none of us are happy when we get turned down by any kind of a credit agency because they don't tell you very much, especially nowadays with the new federal credit laws. Having said that, I think we need to move on. We have some people in the next group that have to leave. We want to make sure they have a chance to testify. Thank you all for coming. I know some of you have come a long way. Really appreciate your input and the hard work that you've done to prepare for this hearing. Thank you. I'm going to move the agenda around just a little bit, only to accommodate some people that have to leave. We're going to move our loan modification advance fee ban portion up in front of the impact on tenants. So I'd like to ask Russell Weiner and Jeff Dobby to come forward, please. Thank you. Yes,
Good afternoon. I'm the interim chief trial counsel for the Office of the Chief Trial Counsel, State Bar of California.
There you go.
We are the discipline arm of the State Bar of California and of the California Supreme Court. I think my message would be that that SB 94 has been extremely effective in accomplishing its purpose. To give you some numbers, from January 1st of 2009 until last Friday, we have taken in almost 4,000 complaints involving allegations of misconduct in providing loan modification services by attorneys. About 1,600 of those complaints have come in since the effective date of SB 94 in October, but most of those complaints relate to misconduct which occurred prior to October 11th, 2009. There's often quite a lag period before we get a complaint. So the fact that we're still receiving a large number of complaints does not indicate a problem. And actually, of the about 1,600 new complaints that have come in since the effective date of SB 94, only about 13 involve an allegation that the lawyer took an advanced fee before providing or in offering to provide the loan modification services. In fact, when the law went into effect, we received many calls about what it meant and how to comply with it by attorneys. Some of the suggested ideas of how they could were silly, but I think they were in good faith trying to comply. But I think that the report is that SB 94 is working. It has increased. The loan modification problem has increased the State Bar's investigative workload by almost 100% from where it was a year ago, and that's still probably going to be a problem for us personally for quite some time, because complaints will come in. There were really thousands and thousands of homeowners that were taken advantage of prior to SB 94. But without SB 94, I think I can't imagine what we'd be looking at today. So that's been very effective. We have seen some morphing perhaps of the problem, lawyers looking at whether or not, or offering debt modification services instead of loan modification services. So, but it hasn't really become what I would consider a serious issue at this point. But what it did is it took the financial incentive away from lawyers who were really using it as a vehicle to defraud unsuspecting homeowners, and from participating with non-lawyers who were using these lawyers in order to do the same thing. And so it's been very effective in that regard. If anything would help, it would be that we need to have some greater enforcement in going after the non-attorneys that are a big part of this problem. In many of the cases that we saw, there might have been just one or two lawyers involved, and literally 50 or 100 non-lawyers working in a boiler room type situation, signing up people, making promises to them that had no basis in reality, and taking upfront fees and doing no work and not communicating and not returning the money. So,
thank you. Mr. Dunn.
Okay. Good afternoon again. Thank you for having me back. And just to cover briefly on SB 94, I have provided that packet, which on the right side of your index, you'll see the testimony I'm about to give, as well as all of the background information I'll be referring to. First of all, the question of SB 94 in terms of its need, it was undeniably a needed piece of legislation, and one that I, of course, welcomed, and that I think all of the consumers of California facing foreclosure welcomed. When you look at what was happening prior to October 11th, 2009, you had basically attorneys, foreclosure consultants, real estate brokers, and then many predatory people impersonating one of those three out there collecting advance fees under the false promise of providing a loan modification. Similar to what we saw at the State Bar, what you just heard about, we've seen our statistics at DRE go through the roof. In July of 2008, for example, prior to this testimony and prior to the bill being passed, we had less than 10 complaints involving advance fee issues. When you get down to what's happened over the last couple of years with loan modifications, the department has processed over 2,400 complaints. And of those complaints, we have issued 400 decision refrain orders. If you add accusations, it goes to 520 accusations. And we continue to get complaints about loan modification services being promised and the advance fee issue. But what we found is since October 11th, most of the complaints are still about prior activity taking place. We've only found 30 examples since the first of the year where they were violations after the passage of SB 94. In terms of the department's implementation of SB 94, we had a three-pronged approach. Our outreach involved a lot of the consumer events that you heard about, whether they were consumer protection events to provide loan modification services, or we had about 50 legislative events with state, federal, and local legislators. We also did a lot of brochures and read on our website, provided consumer alerts, which are all in the packet as well. And then on the enforcement side, the most notably was working with our partners, the State Bar, for example, the AG's office, and the district attorney. We would find ourselves many times providing consumer alerts that were put together cooperatively to protect the consumers, and of course working with our partners to make sure that actions were taken against those individuals. One new thing we did is we actually started publishing the bad actors, if you will. And it's interesting to note that just like for the State Bar, 60% of those that we found going afoul of the law were not real estate brokers that we licensed. So we did a lot of decision refrain orders without accusations. But nonetheless, there's still a significant number of individuals who were not complying with the advance fee provisions prior to SB 94, and not as many now continue to do that after SB 94. So I guess with that, I'll just go ahead and open up to any questions you have.
Can I just add one? Yes, this is probably the best interagency effort I've ever seen since I've been at the State Bar in 22 years, with the State Bar working with other offices, law enforcement, both state and federal, in trying to deal with this issue. Yeah. And so I've never seen that before in anything. So it's really been pleasing to have that. And just in terms of our effort, we've obtained the resignations of 12 of the worst offenders, and we're still working on our list of targets to try to take them out as quickly as possible.
Do you both feel that we have adequate resources to continue to reinforce 94?
Well, I would say I need more people.
I would say the same thing. It's about
that wasn't
20%.
in your testimony just a little while ago.
It's become about 20% of our enforcement right now, but that's what we do. So we go where the fire is. So yeah,
you're doing a great job with very limited resources, and I really appreciate it.
Thanks.
Thank you very much. There's no other questions, so you're free to go. Thank you.
Okay, thanks a lot.
Okay, now I'm going to move back to our regular agenda, which is the impact on tenants of our sevens, and that is Christine Minahan, Director of Legislative Advocacy, Western Center on Law and Poverty, and Dean Preston, Executive Director, Tenants Together. Please come forward. Welcome. Ladies first, whenever you're ready.
Mr. Chair, with the Chair's permission, we would like to start with Dean Preston, who is in touch statewide with tenant groups on this issue, and then I will follow him.
Okay, great.
Good afternoon, Mr. Chairman. Thank you for the opportunity to address you on the impact of foreclosure crisis on tenants and also on the specific tenant right measures, how they're being implemented, and what we are seeing on the ground across the state and what we're hearing from tenants.
You may answer my question, but just something for you to think about when you're testifying. We've heard some incredible numbers on the foreclosures that we've had over the last couple of years. Is there any way to determine how many of those were occupied and how many were not?
Well, the big question that we've looked into, and it's been surprisingly difficult, is to determine which ones are owner-occupied at the time of foreclosure and which ones are tenant-occupied. I think when the crisis first emerged, everyone was focused on the owner-occupants, and it was only a year or so in where people realized a significant portion are renter-occupied. We did a study last year that found that over a third of the units in California where there was actually a foreclosure were renter-occupied. We are doing, in a couple weeks, we'll have a new study on the 2009 numbers. Unfortunately, the foreclosure radar, which does gather those, and you heard from the gentleman earlier, they've actually stopped counting or tracking whether people are owner-occupied at the time of whether the homes are owner-occupied.
There's no way to determine if the home was actually occupied or it was just either abandoned or vacant.
Currently, there isn't, other than to apply general vacancy rates to those properties and assume.
Right.
But you're right. There's no hard data on that.
Okay. Proceed. Thank you.
Thank you. Our organization, Tenants Together, is California's only statewide organization for renters' rights. There are currently an estimated 14 million renters in the state of California, and a growing number of renters are being affected directly by the foreclosure crisis. It's important to remember when discussing renters in the foreclosure crisis that these are generally rent-paying tenants who want nothing more than to stay in their homes. They're clearly innocent victims of this crisis who had no part whatsoever in the facts leading up to the foreclosure. Hundreds of thousands of tenants have been displaced because of foreclosures on residential property. And as I listen to many of the speakers today, I note that much of the discussion is about avoiding foreclosure, and very little focus is on what happens after the foreclosure. When statements are made by industry representatives that anyone who wants to stay in their home, they want to make that happen, there's an opportunity after foreclosure to make that happen, whether the person is a renter, and we advocate for renters, but also for former homeowners. There's absolutely no reason that foreclosure should necessarily lead to displacement from the homes. Those are two different things. Fannie Mae, for example, has adopted a policy where they offer one-year leases after foreclosure. foreclosure to any eligible folks in their properties. And those kind of solutions make a lot of sense, not only for tenants in those properties, but also, as Bloomberg News reported, for the banks who gave up in 2008 alone $1 billion worth of rental income by moving to throw rent-paying tenants out of their homes instead of continuing to rent. And obviously this has implications for vacancies and blight, because when the tenants move, the properties are empty. So you have tenants who want to stay in their homes and pay rent who are being displaced so that properties can sit vacant and turn into problems in the neighborhood, further depressing home values in the neighborhoods. The particular tenant rights measures of which you're well aware, SB 1137, which has been discussed, had the tenant rights piece making sure that tenants were notified of the trustee sale. Prior to that, tenants had no notice until the foreclosure that anything was happening. And the other piece of it was to increase the notice of eviction from 30 to 60 days. Since I was here on a similar hearing a year ago, the federal government passed, President Obama signed the Protecting Tenants at Foreclosure Act in May of 2009, which essentially expands the protections that SB 1137 provided, increasing the notice period across the nation to 90 days for tenants in this situation, and also providing that leases are survive foreclosure, and that the bank or other entity taking title at foreclosure takes title subject to the rights of tenants under leases, with limited exceptions where the bank sells to someone that wants to own or occupy the premises.
You're saying that's proposed federal legislation, or is
that is federal? It was signed into law May 20th of 2009, and is scheduled to sunset December 31st, 2012. These were significant advances in the protections for tenants, both SB 1137 as well as the federal law, at least providing more notice for tenants who are forced to move in this situation. Unfortunately, while it has protected some tenants, what we see is widespread violations of both of these laws. We operate California's only hotline for tenants in foreclosure situations. We counseled over 3,000 tenants in just the last year, and so we're in a good position to see across the state how these laws are being carried out. We receive numerous complaints. I would say the three main things that we see, and perhaps the biggest complaint, is the conduct of real estate agents in how they interact with tenants after foreclosure. The real estate agents very rarely provide accurate information to tenants about their rights, and in fact the callers we talk to almost across the board, I mean certainly the vast majority of them, have received misinformation about their rights from real estate agents who are trying to get them to vacate earlier. We also see a lot of confusion among tenants.
So even with 1137 in place, you're still seeing lenders that are misleading and misinforming tenants and trying to get them out earlier than the law now requires.
Absolutely. And
so 1137 is not working.
Well, I would say where it is complied with, it is working. Tenants have a greater notice period, and there are certainly some folks, when tenants learn about their rights, if they call our hotline or they go to a local legal services agency and they learn that they don't need to vacate next week just because the agent came and told them they have to, then for those tenants it works.
We just had all three commissioners up here tell us that all the lenders were complying with 1137. So if they're complying and yet we're still having problems with the tenants, you know, where's the breakdown here? How do we ensure that lenders are following through with what has been seen as compliance by the agencies?
Well, I think they were testifying to compliance with the loan modification requirements, the contacts with borrowers. And I understand from folks dealing with this at the federal level that a lot of the banks are not comfortable certifying that they are in full compliance with the protecting
I asked them several times, and they said that banks said they were complying, and the agency said that they were examining that each lender was complying with 1137, which has three parts to it. So I'm trying to find out where where the breakdown is here.
I think the disconnect is between the banks and their agents. And I think that the banks may have a policy that they follow 1137, and they may have a policy, and do have policies that they comply with the Federal Protecting Tenants at Foreclosure Act, but that doesn't mean that the individual on-the-ground local agent who is dispatched to go speak with the tenant about their options is accurately presenting those options, and particularly when there's a conflict, quite frankly, that agent, their goal is to vacate the property and market it as quickly as possible. So they're not necessarily the best people to be accurately advising tenants of their rights.
Okay.
So the real estate misinformation is a major problem. Tenant confusion about who owns the property, where to pay their rent, who's responsible for repairs is another major problem that we hear from tenants across the state. And the third problem is, and it's not just the real estate agents in terms of bank agents, but the attorneys who are eviction attorneys are often moving forward prematurely in violation of 1137 and the Protecting Tenants at Foreclosure Act to displace tenants. Typically, that's because they're proceeding as if the properties are owner-occupied, when in fact they're tenant-occupied. So they serve a 3-day notice and then move forward, file eviction papers in court to displace everyone in the property. So that's another very common complaint. Okay. Obviously, from, and I'm sure I've exceeded my time by now. My apologies to Christine, but obviously from these
But I'm asking you questions.
It's not just legislative solutions. There are obviously enforcement issues, and we hope that the Department of Real Estate and California Bar Association will move forward on individual cases and to advise their licensees.
We're going to talk with the commissioners. We're going to talk with the commissioners too, and see if they can focus a little more too on that part of the compliance portion and do some follow-up.
Thank you.
Thank you so much.
Christine Minahan, Western Center on Law and Poverty. I'm going to follow on where Dean leaves off in terms of the problems that we're seeing with SB 1137 and some other suggestions that he touched on. The problem that we're hearing from legal services offices all over the state of California is that tenants are either receiving entirely ununderstandable notices of eviction, or that they're receiving a stack of papers that has the 3-day notice, the 30-day notice, the 60-day notice, and the 90-day notice. And they're all addressed to the former owner. The tenant doesn't know if it's 3 days, do I have to move immediately? If it's 30 days, they just can't select from the panoply of notices that they're getting which apply to them. We think that the best response to that would be to create a very clear notice that would be on the cover of anything, any notice that was sent to a tenant in occupancy in a foreclosed home. And it would be a simple sheet that would just simply say, the 3-day notice doesn't apply to you unless you're the owner. The 30-day notice doesn't apply to you because you're entitled to 60 days.
Right.
But it would just simply tell people, this is what you need to do. It will be in plain language. It will be in the 6 languages. And it should say to everybody, don't ignore these notices because you have to protect your rights. A second thing that we have to deal with is wherever tenants would like to be able to defend their rights in court. For instance, they're not, they should not be evicted because they live in a just cause eviction city. And therefore, because foreclosure is not a cause for eviction, that local ordinance has to be recognized. Secondly, if the tenant is on a lease and the owner is ignoring the fact that they have a lease, they ought to be able to go and defend their rights in court. There's a number of other things, but we want tenants to be able to go in when they get those notices and defend themselves. They tell our local attorneys, I'm not going anywhere near becoming involved in an unlawful detainer, because then I will end up on the tenant blacklist. Nobody likes that name, but it's the one that's used throughout California. You defend in an eviction, you're involved in an eviction. On any reporting, credit reporting, it simply says you were involved in a UD. We need to make sure that people that have to go to court to defend themselves against these notices also we can ensure that their names will not go on to the tenant blacklist. We're also seeing the rent skimming, which has been a part of which has been a significant problem in California for many years, but has been tremendously exacerbated because we have so many foreclosed property. The scam, sorry. The scam goes this way. The scam artist identifies houses that are empty. They have the locks changed. They put an ad on Craigslist that this is for rent. They meet the tenant who's interested. The tenant wants to take possession of the property, and they say, security deposit, first month's rent in cash, and I'll turn the keys over to you. So somebody comes to them with $1,500, $2,000, $3,000, which is what those two together generally amount to, and they're out the money when a few days later or a few weeks later, the actual owner, in whatever way, identifies themselves as the owner. We would strongly recommend that in that case, the tenant is going to be subject to immediate eviction, but they have just been scammed of all the money that they have to be able to move. We want to at least, where the scammer was the previous owner and he or she rents the property to somebody knowing exactly what they're doing. All of the scam artists know what they're doing, but it's even more egregious when they've lost their home, but they know it's empty, and so they're going to defraud somebody else of all of their money to be able to move in. The third thing that we would recommend, in addition, of course, to extension of the federal law beyond 2012, 2011, whatever, 2012, is that we need those protections either extended or made permanent in federal law, and a bill has been introduced in Congress to do that, or we will need in California to adopt those protections in state law. Final, very quick example. We're beginning to discover that a lot of the affordable housing that we have been developing around the state is in jeopardy now because the public housing, it's not public housing, but let's say the city of Los Angeles or city of San Francisco is in second place on a loan that goes into foreclosure. They put 10, 20, 60, 100 million into that affordable housing, and that affordable housing is covenanted for sometimes as much as 55 years. If the first is foreclosed upon, the city is not receiving adequate notice to be able to assess, should we buy out the first? Should we do the foreclosure ourselves? How many covenants are we going to save? What will happen to the tenants? Because, of course, the covenants extinguish the minute the first is foreclosed upon. So I think we really need to work with cities, particularly in this time when we're so far short of the affordable housing that we need. I think it would be very wise for us to work with the cities to figure out where in the foreclosure process we can let the city know. They can go to their city council and get the funding approved if they're going to try and save that building. It's not something that can happen in 2 weeks, 4 weeks. Sometimes they get notice of a week and a half, and there's no way that you're going to move ahead with a large piece of property and that money and that complexity. So as the housing advocate who works on all of these programs, I just entreat you to look positively at some solution so that we're not losing. that kind of housing. And thank you very much.
Thank you, too.
Thank you.
Did you have a question, Senator Hancock? Okay, great. Thank you for joining us again. It really is. And thank you so much for your testimony. We're moving on to the second to the last portion of our hearing today, and that's the anti-blight area of 1137. Mr. Higgins, who's the senior staff attorney for the League of California Cities, is here to speak to us.
Good afternoon, and
thank you for hanging around.
Thank you.
It's been a long day.
I will try and go under my time allotment.
I appreciate that. We'd like to finish at 5 if we could.
Yeah, well, I think I can be very, very brief and just limit my comments to trends. First of all, I appreciate the whole focus of today's hearing, because really, if you keep people in their homes, we don't have a blight issue.
Right.
So we're really dealing with this issue as an after a shock, if you will, of the problem the larger problem that we're having. So turning to 1137, we had an issue in that, or a portion of that bill created an enforcement mechanism where local agencies could impose a civil fine when foreclosed properties were not kept up. I'm not an expert in this area in terms of, the actual foreclosures, but I pulled our city code enforcement officers to get a feeling for how this is being applied. And they say that this provision is very successful in getting banks and others who own the foreclosed properties to actually deal with the issues, to have the inspections done. So there's some positive on to the extent that SB 1137 applies, it's positive. There's some constraints to it, however, and the largest constraint is that it applies only to foreclosed properties. And a lot of vacant units actually occur before the foreclosure. And so we have over 80 cities who actually have ordinances that trigger before the foreclosure. They trigger at the notice of default or some earlier period, because the problem is larger than the problem 1137 identified. And listening to the testimony here today, I don't know this for a fact, but if what I heard today is that the effect of 1137 and the sevens, as I've now learned to call them, have extended the foreclosure process, that means I'm thinking that we're dealing with a percentage of those will be vacant prior to foreclosure, which means our problem and the limit of SB 1137's construction is probably exacerbated to some extent.
Did you oppose 1137?
No, we supported it. I should say we supported that narrow provision because, 1137 did a lot broader things that aren't typically within the purview of our police power. That one narrow portion did, so we supported it. The last thing I'll say in terms of the constraint is, and you know this dealing with your budgets, but we have a shortage of budgets as well. So maybe 1137 gave us some authority to impose a really meaningful fine, but as one city told me from the Central Valley in an email, we used to have 8 code enforcement officers and a city attorney dedicated to dealing with this issue. We now have 1 code enforcement officer and had to let go the assistant city attorney as well. So we may have the tool, but we don't have the staff to enforce the tool. And so that's an ongoing problem for us as well. So in the end, our verdict on 1137 is a good idea. If we had staff and resources, great. And we'd like to see that maybe expanded to some extent. Certainly not our local authority limited in dealing with pre-foreclosure properties.
Thank you very much. Okay, our last portion of this hearing is the foreclosure tax relief portion. Can I ask Brian Putler, Gina Rodriguez, and Mark Mosley to come up, if you're still here. Brian's with the legislative director with the FTB, and Gina Rodriguez is the editor for Spadell Publishing, and Mark Mosley is one of us, taxpayer. Yes, Senator Ingram.
Is Fidel Publishing?
It's some kind. Why don't you go
Thank
first?
you for
and we'll explain.
asking. We published the California Tax Letter. We've been in business since 1975, and we teach tax professionals all the tax law updates. Thank you.
Okay, so I'm Brian Putler from the Franchise Tax Board, and we've been asked by staff for the committee to address a number of questions, and that's what I intend to run through today.
Thank you.
So what we're dealing with tax-wise is what is called cancellation of debt income, or otherwise known by tax professionals as COD income. It has been longstanding law, both federally and in California and many other states, that where a taxpayer borrows money from a lender and the lender later cancels or forgives the debt, the taxpayer may have to include the amount forgiven in income for tax purposes. And generally, this amount is considered income and subject to tax, but there are some exceptions. And the exceptions are where the taxpayer is in bankruptcy, the taxpayer is insolvent immediately before the forgiveness of the debt, or we're dealing with a non-recourse loan. So as a result, though, of the economy, the federal government enacted the Mortgage Forgiveness Debt Relief Act, and California conformed with some modifications in SB 1055, and that bill was effective for tax years 2007 and 2008. So what SB 1055 does is it excludes from gross income of a taxpayer COD income up to $250,000, and that's by where it comes by reason of a discharge of a qualified principal residence occurring during 2007 or 2008. The bill specifically provided that no penalties or interest could be assessed on COD income that results from the discharge of qualified indebtedness during those years as well. So we were asked then about the utilization so far of SB 1055, and specifically how many taxpayers had claimed state tax relief on forgiven mortgage debt during 07 and 08, and then how much forgiven debt was claimed by taxpayers during each of those years. I'm sorry to tell you, though, we don't at the FTB have data to answer those questions at this time, and it's for two reasons. Number one, the data that the FTB captures from our tax returns doesn't include those items, and so what we would normally do is have to rely on the IRS data, and we simply haven't received IRS data in a format yet that we can use to make those calculations. But if the committee would like, as soon as that we can make those calculations, we'd be happy to forward that on.
Okay.
Then next, we were asked about the current proposals that are pending to conform. How would those work? And they would work the same way as both federal law and 1055, but with some different ceilings or limitations applied. So currently there are three bills pending: SB X614, Calderon and Correa, SB X832 Wolk, which I believe it's waiting for action by the governor, but I believe the governor has said that he intends to veto it. And then AB 1779 NILO. And all three would conform to the federal law, as I said, with some differences. The two Senate bills would conform prospectively starting January 1, 2009, and while maintaining the 1055 California modification for qualified principal residence income at $800,000, it would raise the California limit from $250,000 to $500,000.
So let's just talk about 14. So if that were signed by the governor by April 15th this year, it would apply to 09.
As long as it was a tax levy. I haven't looked at the bill for that issue in mind, and as long as there was express retroactive language in it, and that, as I said, I'm not sure if there is or not. I don't know the bill quite that level of detail at this point.
If there isn't retroactive language in it, then it wouldn't matter when it's signed?
No, then also there is a General Revenue and Taxation Code section 17034 that would apply, that would say that a tax bill enacted in a given year is generally retroactive on its own terms back to January 1 of the year enacted. So I think with those three elements in mind, I think we'll hit one of them.
Got it covered, yeah.
Okay. And so AB 1779 would conform retroactively to the federal mortgage forgiveness debt relief with no modifications at all. So it would go back all the way to 2007 and then go into the future until 2012. So estimates for the pending bills, we estimate that about 16,000 taxpayers would be able to exclude COD income for the 2009 through 2012 years. And the reason that number seems low is because taxpayers who are either bankrupt, insolvent, or used funds for non-acquisition purchases, such as buying a car, taking vacations, those things expressly don't qualify for the exception. So that's why the number seems relatively small. Then, as far as actual revenue, the SB X614 bill has a 4-year budget window. It covers the years 09-10, that fiscal year, all the way through 12-13, and the revenue loss for each year, respectively, is $10 million, $13 million, $9 million, and $6 million. And those are the questions we were asked to address.
The numbers I have in terms of taxpayers being hit with this short sale are in the 300,000s, and you're telling me that that your estimate that out of those 300,000, only maybe 16,000 taxpayers would have to pay because of, you said, either bankruptcy
or insolvency.
The
vast majority, we believe, are insolvent in that they would qualify technically as being insolvent, and so there's no COD income for them to report.
There's a separate relief provision for insolvent taxpayers that we already have in law, separate from the mortgage relief.
Okay. I learn something every day.
Thank you. Again, my name is Gina Rodriguez. I'm the Sacramento editor for Spidell Publishing. As I stated, we deal exclusively with tax professionals. We teach about 23,000 of them. And those tax professionals prepare about 6 million tax returns. We are right smack in the middle of filing season right now. So COD relief has been a pretty hot topic. As Brian stated, we don't have mortgage relief right now. We only had it for 07 and 08. Feds have it from 07 through 2012. There are pending bills. Taxpayers know this, that there are pending bills. Because of this, it's been a wait-and-see game for taxpayers in this situation. So when they walk into their tax professional's office, they are generally advised to, let's wait and see what California is going to do. Let's file on extension. And that's generally what they're doing. So we may not see these people file until October 15th, 2010. Many taxpayers who lost their homes have also lost their jobs, but the taxpayers themselves are under the assumption that California already conforms, and we don't conform to the federal rules. They know that federal relief is out there for them. So it doesn't even cross their minds that there might be a state liability when they finish their California tax return, and does come as a complete surprise to them when their return is complete. Now, these taxpayers, generally unemployed, can't afford a $10,000, $15,000, or whatever the liability is going to be to California because of this cancellation of debt income. We, as tax professionals, we tell them to please stay compliant with the state. Please continue to file on time. We know you can't pay, but you need to continue to file. We'll get you on a payment plan if we can. Many of them don't go on payment plans. They actually go into collection action, or they go underground, and we don't see them again until the economy starts to pick up. As Brian mentioned, many of the taxpayers that are...
Well, you're right there on the payment plan issue, and we're still talking about this short sale tax. What determines whether a taxpayer is insolvent? And who determines that? I mean, obviously, if they lost their home, they probably are.
By definition, insolvency means the excess of liabilities over the fair market value of your assets.
Excessive liabilities over the fair market.
Fair market value of the assets. Although
So your mortgage plus all your other bills.
Plus all your other bills. However, in determining, the interesting thing about insolvency and determining whether you're insolvent, you have to include your retirement accounts into your asset calculation, which is where we get into some problems for some taxpayers. So insolvency does apply to many taxpayers, and I think I vouch for Brian that maybe the COD mortgage relief is for a limited number of taxpayers, but it's a very important provision for those taxpayers who don't qualify for insolvency. Final note. We know the accounts receivable at the state, just specifically at the Franchise Tax Board, is going to rise. I just got the latest numbers. As of February 2010, it was up $668 million over February of 2009. The accounts receivable as of February 2010 was sitting at $8.6 billion. That's the accounts receivable. This does not include installment agreements. So we know, we're telling all our clients right now, you've got to get on a payment plan. Billion. 8.6 billion in accounts receivable. And it continues to rise. And this number is a bit skewed because, like I said, we're right in the middle of filing season after April 15th, and we see where the receipts are.
And that's a total accumulative of over how many years?
That's their current snapshot of what their accounts receivable is right now.
Yeah, but how many short sales is it? I mean,
it's not broken down. I don't have it broken down.
It's not 16,000 taxpayers.
No, it's not. This is all taxpayers statewide.
Statewide.
But the foreclosure problem has contributed to it, and we will see it rise. And that's all I have. Yes.
Okay, that's your overall. Got it.
Overall accounts receivable snapshot.
Gotcha. Thank you very much.
Mr. Chair, may I clarify something? Somebody handed me a note and said when I was describing the 3 bills pending that I had errantly said that SB X832 is retroactive, and what I thought I said, or at least intended to say, is AB 1779 is the bill that's retroactive.
Yes.
And that the other 2 bills are prospective. So
that's what I thought you said.
You did say that, I think.
Yeah.
1779.
Okay.
Thanks for clearing that up.
Okay.
Yes, sir.
Thank you.
Mr. Mosley.
My name is Mark Mosley. I was asked by Eileen to come down here in the tax relief. I've been listening the last 2 hours from bankers or whatever. I don't know how that affects me. A lot of numbers, a lot of whatever. My wife and I have had our house for 13 years in Vacaville. We had direct deposit on our mortgage, paid down the month once a year, paid an extra payment once a year. Modification comes, we were an adjustable rate. We asked for a modified loan. They wouldn't even talk to us. Our bank wouldn't even talk to us. You have to go into 3 months default. We didn't want to do it, but...
How long ago was this?
This was last year. This was September of last year.
Okay. And who's your bank? Who's your lender?
Wachovia Mortgage.
Wachovia.
So what we did is we wanted them to just put our loan into a fixed rate loan. We had an adjustable rate. Any fees applied, any late fees to put on the backside of the loan, we would be willing to pay. We just wanted to restructure it. We didn't want any money. We didn't want any of this. My wife has become permanently disabled, so our income's become very fixed. As of this year we went to get our taxes done. Generally, I don't know, I just take the taxes, kind of got a little envelope, take it to the preparer, here you go. Well, I got a 1099, which I've never had before, and $59,000 tax forgiven on our loan. I'm shaking now. We owe $21,000, my wife and I, 12 to the feds, 9 to the state. If I knew that this was going to come from just restructuring my house loan, obviously I wouldn't have done that.
So they restructured your loan, and you got a tax bill.
And we got a tax bill. Oh yeah, oh yeah. And so, to say the least, we were devastated the last 2 weeks, my wife and I. Physically, I heard you mention retirement. My 401 said we couldn't get into it. Paying taxes is not a good enough reason to get into your 401. So now we really don't know how we're paying this. Come to find out, that the feds, with this and the held by Eileen, that the feds have banned this through 2012. So the 12,000 is apparently washed or relieved. Okay, thank you. But I still owe the 9. We still owe the 9 for the state. And I called. I thought it was interesting because I heard these bankers say how they work with people. Well, I called our bank, Wachovia. I was told to go to irs.gov, publication 4681, form 982, find out if I owe the money. That's their response to how they work with me. So that's pretty much my story. My wife and I are devastated. We're on fixed income. We have no idea how we're going to pay this debt. We're in worse off shape than we were before we even asked for the modification. I mean, I wouldn't have even done it. I get a little excited. I wouldn't even gone that road. We are worse off with this. So that's.
So if I can just clarify.
Sure.
So you were lucky enough to you got the 12,000
right
forgiven, and then you got a loan modification, which lowered your payments.
They said that what had happened is our original mortgage is $325,000.
Yeah.
On the paper, I went back to look at it, and it said carrying over the new loan would be $265,000. Me not being a lawyer, whatever, I'm thinking, okay, due to the recessed economy, this is the appreciation of my house.
Yeah. No.
I didn't do the math. I didn't subtract the 325 to the 265. Boom, there you go. You know what? And that's as simple as that.
They did a principal.
They did.
And that's where the debt came from.
Got it.
So, and being doubled.
If you didn't, I'm sorry, sir. If you didn't have that 9,000 that you owed to the feds, would you be able to stay in your home?
Absolutely. The difference of the 9,000 of what I would do, I'm going to either owe comes out to $3,968, or with relief, I'll get back $304. So, absolutely. That's 2 months mortgage, absolutely.
I think he's saying with the COD relief, if the state would provide it, he would get a refund of $300.
$300.
Right. Well, that's what, I have forms right here calculated either way. I mean, it's legal. I'm just knowing what I've got to come up with and what they're telling me and so forth. So if we had the relief or ban or whatever terms are used, one way I'd have $304. The other way, I'm paying the 9,000. So, and would that keep me in my? I don't know what. I don't have a clue. I mean, when my 401 says I can't get into it to pay this, I don't know what we're going to do.
I appreciate you sharing that with us. Well, it's unfortunate, and that's why we're looking at legislation that we've already implemented to see if it's working, and if it's not working, what else we need to do to help people like you. As you heard, we have 3 similar short sale bills in the process right now. If signed, would in your case, at least on the state level, you wouldn't even get the bill. But
my understanding, what I've read and gotten into this, is that the state had this ban, or I call it the ban because that's the paper, 2007, 2008. It's passed, gone to the governors. I mean, very frustrated, the problem is, it's not, okay, if you do this, for these banks, I heard this testimony, the banks aren't saying, if you do this, this is what you get. I'm sorry, it didn't happen to mine. Maybe it does somewhere else, but it sure wasn't happening to mine because I obviously wouldn't have walked in to a $21,000 debt and risk this, after 14 years in my house.
Right.
Got it. Well, thank you very much.
Thank you.
That completes our hearing today. I think it was well worth the time, and obviously finishing on a really sad note. I'm really sorry about that. But we learned a lot today, and I think what we have to look at is I think we've determined that the legislation is working. It isn't working to everyone's satisfaction. There's a lot of bugs, in the in the process. I think it's good that the lenders were here. They were here for the entire portion to hear what those problems were. They heard from Mr. Leonard and others, the consumers groups, as to what kinds of problems we are still experiencing. I know that in my district, we've had a couple of loan modification clinics. They're an incredible tool. They help out hundreds of people, and we need to do more of those all over the state. As Senator Corbett mentioned earlier, I think we do need to reconvene in maybe 3 to 6 months, look at the new numbers, again, see if we are making progress in the right direction, or if there's something else we need to do to improve our results. So with that, thank you all, for those that are left, for staying, and staff that did a great job and fantastic job in preparing for this committee. And this hearing is now coming to a close. Thank you very much.